1, 2, 3, 3 columns. Our figures are in shillings. We start with net loss. So net loss, it is 1270. You add what we've called the disallowable expenses. Disallowable. So generally, disallowable expenses are going to be expenses that had been deducted by the accountant in arriving at the loss, but they should not have been deducted. So to allow is to deduct. Similar to the concept, the matching concept in accounting, where you take the income and then you match the expenses, you less the expenses. So expenses that the accountant had deducted, but they were not meant to be deducted, are what you're calling disallowable expenses. So we add them back. So we start with the notes. So under note 1, we have auditing subsidiary. Auditing subsidiary is an amount of 100. Then we have revision of accounts. They used 80,000. Then we have breach of contract. An amount of 180,000. Then there was VAT penalty of 64. Then there is partition of 120. $120. Then there is embezzlement by cashier. So we shift to this other page. The cashier took away 60. Then we have staff catering and then stamp duty on land. Stamp duty is 190. Note 4, general provision for debts. It is an amount we check from the previous page, 96,000. Then we have capital allowances. So let's check what else from the income statement. Interest on loan, stationery loan, repayment of 460. $460. Then depreciation of 150. $150. Then dividends of 980. Then we have provision for income tax of 120. Provision 4. An amount of 120. Then we shall add proceeds from sale of machinery. Okay, so now we said this is the loss, so we adjust the loss. And because of what had happened, the proceeds from sale of machinery, the item that we identified as non-taxable, because of its inclusion, the loss reduced. So we add it here to adjust the loss to what it should have been had that proceeds not been included by the accountant. So we add proceeds from sale of old machinery. It was 120. Okay. Net loss, we are done. Then we less. What we said is input of depreciation, which is capital allowances. So capital allowances in this case are provided. So you just paste what is provided here in the question. It is 220,000. So that gives us the adjusted income. So let's compute and see whether it's going to be a profit or it's going to be a loss. So we add the figures. You're adding from here 100,000 plus 80,000 plus 180 plus 64 plus 120 plus 60 plus 190 plus 96 plus 96 plus 460 plus 150 plus 980 plus 120 plus 120 minus, okay, wait, that gives us 2720. So minus 220. So this whole computation is giving us a profit of 1230. So this is adjusted profit of 1230. Then part B, adjusted taxable income, is that now we're going to add something. Now this is Baraka Limited. So tax payable or assessments or tax payable. We've said a company is assessed through a proportional tax of 30% times 1230. So Baraka should pay to KRA 369,000. That is the match that they owe to KRA. So that brings us to the end of that part of the question, question 4B. Now it's dealing with taxation of income of a company. So we have adjusted the income from a net loss. We've added disallowable deductions, and we have ended up with a adjusted profit. So the reason why this loss has turned into a profit is because there are some things that the accountant had deducted, but he was not supposed to deduct in arriving at the loss. So we have a loss negative figure. We add all these and it turns to a positive. So in a question where maybe the examiner would want to know what are the things that would make a loss or accounting profit to be different from the adjusted profit, these would be the reasons. That they had computed depreciation, we are supposed to allow for capital allowances, that some expenses like all these had been deducted by the accountant, but he was not supposed to deduct. And again, there are some incomes like this on sale of machinery that the accountant had considered in arriving at the profit or the loss, but they were not supposed to be considered. Then after that, you remember, you're going to use a proportional tax of 30%. 5%. Now, like everything else in tax, this rate might change from time to time depending on the provisions of the Treasury. So that brings us to the end of the question. Thank you so much for being part of the lesson. I'll see you next.
Enroll your child for the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a cost-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
Hello learner, thank you once again for choosing to attend this lesson. Our today's lesson is a continuation of the topic on the theory of consumer behavior. The theory of consumer behavior. The theory of consumer behavior. This theory helps us understand how consumers behave in the market, how they use their income to purchase different commodities, different quantities at different prices in the market. Okay, and in our last lesson we defined the meaning of certain terms like utility. We said utility is the ability of a commodity to satisfy a human want. You went further and stated the various approaches to consumer behavior, the cardinal approach and the ordinal approach, and we went further and introduced the subtopic of the marginal utility analysis. Under that, we define the term total utility, marginal utility. I illustrated by drinking some juice on to illustrate the point on the marginal utility being the additional satisfaction that a consumer derives from consumption of additional units of the same commodity. So today I went further and manifested publishers to make available another glass of juice, which I need to use in recap. I say that as you drink the first glass of juice, you will derive satisfaction from it. Under the cardinal approach, under the cardinal theory, satisfaction is quantifiable, it's measurable. For example, the first glass of juice can be assigned, say, 20 units. So if I have to drink this glass, that satisfaction under the cardinal approach is quantifiable. You can assign quantities. Then we went further and saw the relationship between the marginal utility and the total utility, the mathematical relationship between the marginal utility and the total utility. We say that the marginal utility of after consuming a certain product or unit, for example, the second unit will be equal to, we said, the total utility of the second unit minus the total utility of the preceding unit, the total, which we here we abbreviated as TUN. Then the total unit of the preceding the total utility of the preceding unit will be 2 minus 1. That's what we saw. One way of computing the marginal utility using the total utility. Another way we say would be to get the change in the total utility divided by change in the quantity consumed. The quantity consumed. This you can refer to our last video. We used an illustration and worked out that. So today's lesson we want to proceed and look at what I'm calling the marginal utility and total utility schedules. Marginal utility MU and total utility TU schedule. And this is simply a table. We look at the schedule and graph. Schedule and graph. This is what we are going to do in our today's lesson. A schedule, the MU and the TU schedule is simply a tabular presentation of the units consumed at different levels and their corresponding total utilities and marginal utilities. For example, in our last lesson we gave an example of consumption of juice. Consumption of juice. Example is a consumption of juice. So the first column here was the number of units consumed, and one unit was a glass of juice. Then we had the marginal utility MU. Then we had the total utility TU. So the first glass gave a satisfaction of 20 units, the second one 15 units, third 10 units, fourth 5 units, fifth 0, sixth -5, seventh -10, giving us total utility. If you are to use giving us total utility here, we accumulate the utilities 20 plus 15, 35 plus 10, 45 plus 5, 50 plus 0, 50 plus 5, -5, 50 plus -5, 45, 45 plus -10, this is 35. This is 35. So just a reminder to remind you again, mathematically we said we can compute this marginal utility of consumption of a unit using this formula. For example, if you are to take the marginal utility, if you are to determine the marginal utility of, say, the third unit 3 will be equal to TU 3 minus TU 3 minus 1. That means n minus 1, meaning the total utility of the preceding level. So in this case, we have the total utility of after consuming product 3, I mean the total utility after consuming the third unit, the third glass is 45. This is 45 minus the total utility of the preceding, this is the third glass, this is the preceding level of consumption or unit, and you can see there 35. So the marginal utility derived from the consumption of this glass of juice, okay, the third glass of juice will be 45 minus 35, which is equal to 10. This 10 here, marginal. Alternatively, we can use this formula. The change in total utility after consuming the third class, the total utility is 45. This is 45 minus talking of change, minus the preceding. That will give us the change. There is a change from 35 to 45, which means we subtract 35 from 45, or 45 minus 35, 45 minus 35 over the change in the quantities consumed. Okay, quantities consumed, the change. There is a change here from 2 to 3. So we take 3 minus 2 to get the change. 3 minus 2, and you can see this is equal to 10 over 1, which is the same as 10, which we calculated here. So that is very important for you to remember. This we did in our last lesson, just as a reminder of how to mathematically derive the total utilities from, the marginal utilities from the total utilities. So we now proceed. We will go on with our schedule. This is an example of the marginal utility and the total utility schedule, and I said it's simply a tabular presentation of the quantities consumed with the respective marginal utilities and respective total utilities. So we can use this data to draw a diagrammatic presentation. We can have here a graph. On the y-axis will show the marginal utilities and the total utilities. Okay, so we'll have 5, 10, this is 0, 15, 20, 25, 30, 35, 40, 45, 50. So on this graph we'll have the marginal utilities and total utilities. Then here we'll have the units consumed, the number of glasses consumed, 1, 2, 3, 4, 5, 6, 7. From the table from the table, from the schedule. We can start off with the marginal utilities first. You can draw the marginal utility graph. So on consumption of the first glass, the marginal utility is 20 units. Second graph, the marginal utility is 15 units. The third glass, the marginal utility is 10 units. 10 units. 10. Okay. Then the fourth glass marginal utility 5 units. The sixth glass, the fifth glass, the marginal utility is 0. Then the sixth glass, the marginal utility is negative 5, negative 10. If I was to drink the sixth glass, then the marginal utility will go down to negative 5. Negative 5. This 5 here is negative. Then the last glass, the seventh glass, the utility goes further down, decreases to negative 10. Negative 10. So see, this is, if you are to draw this curve, it shows a downward, sloping downwards. Okay, it's downward sloping. -5, negative 5, negative 10. So this is the marginal utility curve. Then you can plot the total utility curve. Total utility curve, the first glass gave us a total utility of 20. Then the second glass, the total utility goes up to 35. The third glass goes up to 45. That's the fourth glass. The fifth glass, the total utility has risen to 50. The sixth glass is now going down. Sixth glass goes down to 45. Then the seventh glass still on the decline, 35. So if you are to plot this curve, it will take that shape. So this is the total utility curve. So these are the two curves. So what can we learn from these two curves? What can be learned from the two curves? What we can learn here, number one, is that there is a relationship between the TU and MU relationship. There is relationship between MU and TU. There is relationship. There is relationship. TU rises, you can see this TU rises as MU. This TU rises as MU diminishing. Let me write it. 1. TU rises when MU diminishes. As the total utility rises, the marginal utility diminishes, as shown by the two curves. Okay? As this graph is going up, the other one is going down. And it can be seen even from the schedule here. When the total utility is rising, you can see this is the trend here is on the increase from that point to that point, that 35 to 40, 45 to 50. Okay? As the total utility increases, the marginal utility decreases. You see, this is a decrease from 20 to 15, from 15 to 10, from 10 to 5. So the trend here is a decrease. As the total utility increases, the marginal utility decreases. So this is an increase from 20 to 35. Here it has decreased from 20 to 15. At the second level of consumption, there is an increase in total utility from 35 to 45, but on the marginal utility side, there is a decrease from 15 to 10. So that is the first thing to note. Total utility rises when marginal utility diminishes. Okay? And you can also note that the total utility is maximum, number 2. The total utility is maximum when the marginal utility is 0. At this point, the total utility is at maximum of 50 when this is maximum satisfaction. Maximum satisfaction. Maximum satisfaction. When the satisfaction is at maximum, that is the point when the marginal utility is at 0. This is 0 utility. 0 utility. Okay? Total satisfaction. Total utility is at maximum. When it is at maximum, the utility, the marginal utility is 0, as shown here. Here it's 0. This marginal utility is at 0 at this point. This is the marginal utility curve. It is at 0 utility at this point. When the marginal utility is 0, it is at that point when the satisfaction is at maximum. when the marginal utility is at maximum. When the satisfaction is at satiety. That is the second observation. Observation number 2, the total utility is diminishing when the marginal utility is negative. Number 3, total utility is decreasing when the MU is negative. When the MU is negative, the total utility is decreasing. The utility begins decrease from this point. From this point going down, this is the negative region. This region is giving us what we are calling negative utility. And when does that happen? It happens when the total utility is decreasing. The total utility is decreasing from this point here. This is the maximum. It does not go, satisfaction does not go further than 50 units. So from this point there is a decline. It's declining, and it is from this point of declining that we have negative utility. So the total utility is decreasing when the marginal utility is negative. Marginal utility is negative. When the marginal utility is negative 5, that is where at that point the marginal utility is decreasing. So that is the relationship between marginal utility and the total utility. Marginal utility and the total utility. Now, having understood the marginal utility and total utility schedule, we will now focus our attention on the assumptions of marginal utility analysis. And just like any other economic theory, this theory is based on certain assumptions. So you want to discuss these assumptions, and one of the assumption is the assumption of cardinal measurement of utility. Cardinal measurement of utility. Cardinal measurement of utility is an assumption, and what does that mean? Now, this theory states that utility is a cardinal concept. Utility is a cardinal concept. The theory, as we saw last time, utility is a cardinal concept, meaning that it is measurable. Meaning that utility is measurable and quantifiable. Measurable and quantifiable. For example, you can drink 1 glass of juice and derive utility that is measured at 20 units. That's an assumption. Number 2 is the assumption of constancy of marginal utility of money. Constancy of marginal utility of money. Constancy of marginal utility of money. Constancy. What does that mean? Constancy of marginal utility of money. It states that when you are spending money on a commodity, the marginal utility of money remains constant throughout. Okay? The marginal utility of money remains constant throughout. The marginal utility of money remains constant throughout. The marginal utility of money remains constant throughout the analysis. Remains constant throughout the analysis. Then number 3 is the hypothesis of independent utility. Hypothesis of independent utility. Hypothesis of independent utility. This theory ignores the complementarity of goods, that is, between goods. The theory states that the total utility that you get from a collection of goods is a simple sum total. The marginal utility you get from consumption of a good is marginal utility is a simple sum total of the individual separate units, individual separate units or utilities of each goods, of each good. So it ignores the related goods, like the complements, like the substitutes. So the related goods, there is that assumption that the individual units, the marginal utility is just a total. The way you have done here is just a simple total. Just add that to that, get the marginal utility. So that these are the three main assumptions under the marginal utility analysis. So finally, we want to state the law. We want to state the law. This is the law or the proposition. Let me call it proposition, or the law of diminishing marginal utility, the DMU, the law of diminishing marginal utility. What does this law say? Now, the law states that as a consumer consumes more and more of a specific commodity, the satisfaction from the successive units goes on decreasing. The successive units go on decreasing or diminishing. I repeat, the law states that the diminishing marginal utility law states that as a consumer consumes more and more of a specific commodity, the satisfaction from the successive units go on diminishing or decreasing. As I consume the glass of juice, as I go on consuming glass of juice, the satisfaction that I derive from this glass of juice, the happiness that I derive from this glass of juice, the utility that I derive from the consumption of this commodity keeps on reducing, keeps on diminishing, so that as I consume the first glass of this juice, the utility will be measured at 20. When I take the second glass, the utility goes down to 15, diminishing. As I take the third glass, the satisfaction keeps on reducing from now here 15 to 10. As I take the fourth glass of this juice, the satisfaction that I derive from that juice goes down to 0. At 0, there is no satisfaction. That's why you'll find me just playing with the juice, playing with it, put it in the mouth, spit it, or do like this. Seen someone taking food with a frown face, dissatisfaction. Do you understand what I'm saying? It keeps on reducing, so that as I take the sixth glass of this juice, satisfaction now is into negative. Here now it brings what we call dissatisfaction. It is no longer satisfaction. It is now dissatisfaction. And it happens many times when you buy a dress. You've seen people when they are putting on new dress, okay? You can see them walk happily. But if you are to buy the same dress tomorrow, that satisfaction will go down. Those of you who are parents, if you are to go home today with the chocolate, the young ones will be dancing. Mommy, 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 daddy, 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 daddy. Okay? They'll be dancing. But take the same chocolate tomorrow, because they are used to chocolate, they may not dance as they danced the day before. So the satisfaction goes down. So that is the law. That is the law of diminishing marginal utility. Diminishing marginal utility, and it goes on and on like that. We have demonstrated that on the graph. We say that maximum satisfaction, when it is at 50, it is at that point when the marginal utility is at 0. Marginal utility is at 0. So that is the law of diminishing marginal utility. Marginal utility. However, this law does not always apply all the time, because there are certain limitations, or what we call exceptions to the law. Exceptions to the law, or limitations of the law of diminishing marginal utility. So limitations or exceptions. If you ask limitations, in other words, you're talking of exceptions of the law of diminishing marginal utility. One limitation is that this law only works or applies where the goods that are being consumed are identical. In other words, they are one, homogeneous. It only applies to homogeneous goods. Homogeneous goods are identical goods or similar goods or the same goods. The goods must be identical for the law to apply. For example, the glass of juice. You must have the quantities or the product being this juice. When you are doing this analysis, the first unit, in that case, the first glass has to be this juice. Then the successive glass has to be the same juice. The third glass has to be the same juice until you get to your seventh unit. So you don't have a situation where you are today the first glass is juice, the next glass is H2O. No, it has to be juice throughout. If you are analyzing the consumption of water, then it has to be water throughout. So that is the one limitation. Then limitation number 2 is the standard of units of consumption. Standard units of consumption. The unit of consumption has to be standard. Number 2, standard units of consumption. The standard unit of consumption must be reasonable. It has to be standard. So if you are talking of having this size of juice, the size is the size of this glass. If I'm to drink the first glass, it has to be this size. Then if I'm to drink the next glass, the second glass of juice, it has to be the same size. If it is a liter, it has to be a liter. If it's a half liter, it has to be a half liter, so that you don't have the first glass being this size and the next glass being this size. No, there has to be standard, or you don't have this glass and this size. If it is this size, it has to be this size, so that you don't have the first glass being different from the second or different from the third. Okay, so you don't have such scenarios for this law to apply. It may even be smaller, so you should not be consuming this size, the first glass, then the quantity, the next glass is the size of this spoon. Okay, so it has to be standardized. Then number 3 limitation is in regard to continuous consumption. For this law to apply, which law is it? The law that states that as you take more goods, as you consume a particular good, the successive units bring diminishing returns. That consumption has to be continuous. It has to be continuous. So if you are taking, for example, this first glass at 1 p.m., then the next consumption should be immediately. You don't take the second glass tomorrow, or you take the third glass after 3 days. No, it has to be continuous. If you are doing this analysis for this law to apply, then the consumption has to be continuous. That's what we mean. It has to be continuous. Then another limitation is that it does not apply to number 4, prestigious goods. Prestigious goods like e.g. gold, money. Does not apply to prestigious goods like money or gold. The more you get money, the more you want, the more of it. Gold, the more you get gold, the more you'd want more of it. So money and gold and such prestigious goods do not obey the law of DMU. Then we can even add number 5. Number 5, we can talk of number 5 here. 5, we can talk of addictive products. Addictive goods. Addictive goods. Addictive goods like alcohol. The more one takes alcohol, the more one would want it. Does not decrease. The marginal utility does not decrease when you are taking addictive goods like alcohol. The more a person takes alcohol, the more he wants more of it. So that is a limitation, that is an exception to this law. So we have the homogeneous goods, the standard units of consumption, continuous consumption, prestigious goods, and addictive goods. So those are the limitations of the law of diminishing marginal utility. The law of diminishing marginal utility. The utility diminishes, the satisfaction diminishes as you take more of the same goods. It goes down. So that would mark the end of our lesson today, where we have learned quite a lot. We've learned how to draw the MU curve and the TU curve. We've seen the relationship between the MU and the TU. We've seen the assumptions of marginal utility analysis. We have stated the law of diminishing marginal utility and the exceptions or limitations to the law of diminishing marginal utility. Thank you for attending this lesson. We will continue to provide more lessons under manifested e-learning platform. Thank you, and may God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
How are you, everyone? My name is Mr. J.M. Kimani, your lecturer in Management Accounting. Welcome to Lesson 4 of Standard Costing. Now, Lesson 4 is still on variances, computation of variances, and just like a continuation of the Lesson 3. Now, Lesson 4, the question comes from June 2010, Question 4, Part B. June 2010, Question 4, Part B. The question reads that Viwandani Company Limited manufactures a single product branded X. The following data relates to actual output, cost, and variances for the month of March 2010. Actual production, 18,000 units. Actual cost incurred, direct materials, 150,000 kgs at shillings 210,000. Direct labor, that's 2,000 hours at 136,000 shillings. Variable production overheads, 38,000 shillings. Variances, direct material price, shillings 15,000 favorable. Direct labor usage, shillings 9,000 adverse. Direct labor rate, shillings 8,000 adverse. Direct labor efficiency, shillings 16,000 favorable. Variable production overhead expenditure, shilling 6,000 adverse. Variable production overhead efficiency, shillings 4,000 favorable. Additional information number 1 is that the company operates the standard marginal costing system. Number 2, opening and closing work in progress figures were the same. Number 3, variable production overhead varies with the labor hours worked. Required a standard cost card for 1 unit of product X. End of question. Now this one will not have any fixed cost, only the material, labor and variable overheads. Now, we want to get the standard cost card where we require to know the material per unit and the number of and the cost per kg or that. So we can have it this way, that the standard cost card is what we want to determine, and we require to have the following. We have direct material cost, we have direct labor, and we have variable overhead. So you want to know the number of kgs per unit and the price, and we get to know the total here. So we are going to begin with the material price variance. We know the formula is actual quantity in bracket the standard price minus actual price. We do have the answer. First of all, when we determine the actual quantity, we have it already, is given there at 150,000 units in bracket. The standard price you don't have, is this what we are looking for? Minus actual price we have, because we can just divide. The actual material cost has been given there as an amount of 210,000. 210,000, should you divide by 150,000 kgs, this is 1.4. 1.4. The variance is known. The price variance is 15,000 favorable. 15,000 favorable. Now, the arrangement that I have given here is that one where the positive answer is favorable, but negative answer is going to be adverse. So being favorable means that this 1.4 is cheaper than this. So this, what you're looking for, should be greater than 1.4. So we make this standard price the function or the subject, that is. So we are going to open the bracket and we have 150,000 SP minus the 150 times 1.4 for sure is the 210,000 equals to 15,000. So this is 150,000 SP equals to, you transfer to 10 the other side to meet 15 and you add. This is going to be 225,000. So SP shall be 225,000 divided by 150,000. This is going to give us shillings. 225 divided by 150, this is giving us shillings 1.5. So we have known that the price per kg is 1.5. But what about the number of units that we are to use, the standard quantity? So you can have it as the material usage variance, which is given as the standard price in bracket the standard quantity minus actual quantity. We do have that this is 1.5, that the answer we have gotten here is standard quantity, we don't have it, minus actual quantity, we have it as 150,000 kgs. We do have the answer. The answer to the material usage is adverse of 9,000. So 9,000 adverse. Adverse means that this 150 must be greater than the standard quantity. So as we work out, this should be negative. So this will be 1.5 SQ minus 1.5 multiplied by 150,000. This is already 225,000. 225,000 equals to negative 9,000. So that now the 1.5 standard quantity is given by, should you transfer the 225,000 the other side, it will be positive, but 9,000 is negative. So minus 9,000, this is giving us 216,000. 216,000. Therefore, the SQ is 216,000 divided by 1.5. So let me have it up here. So standard quantity is 216,000 divided by 1.5 to get now SQ. So this will be divided by 1.5. This is giving us 144,000 kgs. But again, remember that the 144,000 kgs is for the total number of units. Remember something to recall here, NB. SQ is given by usage per unit multiplied by the actual production. And for sure, if you do have the answer to the standard quantity and you do have the actual production, we can get the usage. So you can see that that is the usage per unit multiplied by actual production. Actual production is given there as 18,000 units. So 18,000, the answer is 144,000. So this is actually going to be 144,000 divided by 18,000. So per unit, we were to use how many kgs? So this is going to be 144,000 divided by 18,000. This is 8 kgs per unit. So it is this one and this one we need in our standard cost card. We come and say that it is 8 kgs we were to use per unit, each at 1.5 shillings. And therefore our cost for 1 unit in terms of materials shall be 1.5 times 8, which is, this is 12 shillings. We have found now for the materials. You see now, our starting point normally is the standard cost card. We do the material price and the usage variance. But this time, we were given the answers to the two. We need to go backward and get the missing figures to get our standard cost card. Then we go to the labor. In labor, we can start with the labor rate variance, which is given as the actual hours in bracket the standard price minus, no, standard rate minus actual rate. This is rate. Actual standard rate minus actual rate. We do have, what do we have? Actual hours. We do have actual hours. It is that 2,000 hours. That's 2,000 hours. In bracket, SR we don't have. Minus actual rate we can get because we just need to divide. The standard, the actual labor cost is 1, that's 6,000. We divide by the number of hours, 32. This is going to give us 4.25, sorry. 4.25. The answer is known. We have been given the labor rate variance. We have been given 8,000 adverse. So 8,000 adverse. So as per the arrangement that the actual rate must be greater than this standard rate. So the answer must be lesser than this 4.5. And therefore, we see that that 2,000 SR minus, this is now the one that's 6,000. This is one that's 6,000 equals to negative 8,000. This is that 2,000 SR equals to, when you transfer 1 that 6, you just need to subtract 1 that 6, you subtract the 8,000. This is 128,000. So SR shall be the 128,000 divided by that 2,000, which is going to be shillings. 128 divided by that 2, this will give us shillings 4. We need that. Then we go to the labor efficiency variance, which is the standard rate in bracket. We have the standard hours minus actual hours. This is actually this is 4 shillings in bracket. The SH not provided minus the actual is at 2,000 hours. The answer is given for the labor efficiency variance, the answer is given as to 16,000 favorable. 16,000 favorable. That means that this at 2,000 must be lesser. So what we are looking for should be more than that 2,000. You can say that this is 4 SH minus this is 4 times, that's 2, which is 128,000, equals to 16,000. This is 4 SH. This is 4 SH equals to, when you add 128 plus 16, because they are all going to be positive, you get 144. So then you have the SH is 144 divided by 4. This will be divided by 4. This will give us 36,000 hours. Then the usage per unit. Remember, we do have the units. Units actual production is the 18,000, and the number of hours are that 6. So therefore we take that 6,000 hours, we divide by the 18,000 units. This is going to give us, divided by 18, this will give us 2 hours per unit. This is what we want. So you come and record here that the labor is 2 hours per unit, each at 4 shillings. So this is going to give us 8 shillings. So you have noted and you have known that as per the budget, we were to use 2 hours per unit, and we spent 4 shillings. And that is the position. Then we come to the variable overheads. Now, variable overheads, we can just divide or either get the hours and the rate, and then you get the amount here. So we can have our variable overhead expenditure variance, which is actually the actual hours in bracket SR minus AR. Our actual hours are already that 2,000. SR we don't have, minus AR. AR means we take the actual variable overheads, which is that 8,000. We divide by the number of hours, which is that 2,000. That means actually we have a rate of 1.1875. The variance, the overhead expenditure variance, actually is 6,000 adverse. So this is 6,000 adverse. Meaning this is that 2,000 SR minus, that's 2 times the 1.1875 is at 8,000 equals to negative 6,000. This is that 2,000 SR equals to, when you transfer that 8, you are going to subtract 6. So that will be that 2,000, of course. So SR shall be that 2,000 divided by that 2,000. This is shillings 1. So you have known actually the rate is 1 shilling. Then we come to the standard. We already know. We don't need to go to the variable overhead efficiency. We know that the standard hours per unit, we know it is 2 hours. Remember, it does not change. It is the same. What you write for the labor is the same you write for the variable overheads as per the usage, and therefore we already have it. Even if you are to use the variable overhead efficiency variance, which of course it is the standard hours, which you know they are that 6, and the actual hours are 32. If you get the difference, you'll get some 4,000 hours favorable. 4,000 times 1 bob is 4,000, and it is true. It is 4,000 favorable. So therefore, we just come and write here. It is 2 hours here, 2 hours, each at 1 bob. This is 2. Therefore, This is 22 shillings as our cost. This is our solution. This is what we were asked to determine, that we get to know how much cost is this, and we have managed to get the cost for material, for the labor, and for the variable overheads, giving us a total of 22 shillings. So that is something that we require to understand. Now, finally, on what we have done, we can put all those variances together and we do some reconciliation of variances. So let's have here reconciliation of variances. With that understanding, we have derived from this exposure. We can now have what we call a reconciliation. So this is reconciliation of variances, not of profits. So this is using variances. So reconciliation using variances. So looking at November 2011, this is November 2011, question 5, part B. November 2011, question 5, part B. This one is on reconciliation of profits, and especially it is the budget and actual profits. Budget, profit, and actual profit. So using the variances, of course. So the question reads that, XYZ Limited produces a product branded ZEC. The company operates a standard costing system. The budgeted product information for the month of October 2011 was as follows. Selling price per unit is shillings 160. Cost per unit material A, 6 kilograms at shillings 15 per kilogram, which is 90 shillings. Material B, 4 kilograms at shillings 3 per kilogram is 12 shillings. Labor is 5 hours at shillings 9 per hour, which is 45 shillings. Budgeted production in units is 20,000. Additional information number 1, budgeted fixed overheads amounted to shillings 90,000 per month and are not absorbed into the product costs. Number 2, the actual data for the month of October 2011 were as follows. Actual output is 19,000 units. Selling price per unit is shillings 150. Material used, material A is 98,000 kilograms. Total cost is 1,249,500. Material B, 50,000 kilograms. Total cost is 145,000. Labor cost is shillings 10 per hour. Total cost is 700,000. Fixed overheads incurred were 86,000 shillings. Required, prepare an operating statement which reconciles budgeted and actual profits using variances approach. End of question. Now the requirement here is the profit is the reconciliation statement. So this is reconciliation statement. So we normally start with the budgeted profit, which of course you can tell it is the budget quantity times the budget profit per unit. So this is a budget quantity times budget profit. So in our case, the budget quantity is 20,000 as provided each at the budget quantity or budget quantity is that 28,000 given there. 20,000, sorry. The budget profit can only be taking the budget price, which is 160 shillings price, minus all other costs, which you do have. We do have 90. 90 is material, 12 material, 45 is labor. We do have you don't have the variable, but you have the fixed. The fixed cost is 90,000. We require to divide by the budget production of 20,000 to get the cost. So that now we can have this is 90 minus 12 minus 45 minus. The cost is taking 90,000 total cost of fixed 90. We divide by the total units, which are 20,000. This is going to give us a 4.5. So 4.5. Meaning that should we take the 20,000 each at the budget profit is actually 160 minus the whole of this is going to be 90 plus 12 plus 45 plus 4.5, which is now the budget, the total cost, which is 151.5. So this now will give us a total of, so 160 minus 151.5, then multiply by 20,000. This is 170,000. This is what we budgeted to make as profit. If you don't bring the 4.5, which 4.5, remember, it was the 90,000 budget fixed cost. You divide by 20,000 units to get to know how much it is per unit. If you don't bring it, it means you'll be having not profit but the contribution. And because you want to have the contribution, the profit, you can do it that way. Or you can just take the budget contribution, which is 160 minus these three that are provided in the question. The answer you get after multiplying by 20,000, that answer you can subtract what? 90,000 in full. You still get your 170. This is what I mean. That should you take the cost given there as 160, you subtract now 90, subtract the 12, subtract the 45. For sure, you'll get a contribution of 13 shillings. 13 times 20, you'll get 260. 260, you subtract now this 90, which is fixed cost. You'll be able to get 170. In short, you can even use a profit statement or an income statement where you have your sales, your costs, including the fixed cost. You get your total profit down there, which is 170. Then now you come to operating variances. That we have, the first one is material price variance, which is actual quantity in bracket the SP minus AP. We have material A and material B. We just need to substitute them. The actual quantity are given in information or either given in note number 2. That we have used 98,000 kgs of material A, and this is 50,000 kgs of material B. The budget price per unit up there, as per note number before information, we were to buy at 15 shillings per kg and 3 bob per kg. But the actual price we have spent, if we just make some division, like we have the 12,49,000, which is the cost of materials, which you divide by the number of materials. This is 12,49, 500, 12,49, 500. We divide by 98,000. This shall give us 12.75. 12.75. That if you are to determine the variance, this is minus 15 or from 15 shillings. There is a saving of 2.25 multiplied by 98,000. 98,000. This is giving us a favorable variance of 220. 500. Favorable variance 220, 500. When you come to the material B, the actual cost is 145,000. You divide by the number of units, which are 50. That means we have spent 2.9. And that means we have saved some 1 or 0.1. This is going to be 5,000. Favorable. So that means we are through with the material price variance. Then you come to number 2, which is material usage variance, which is standard price in bracket standard quantity minus actual quantity. We have material A and material B, where the standard prices are the 15 and the 3 shillings provided. The standard quantity is what we have been doing. Like I've given a formula that the standard quantity is actually taking the usage per unit times actual production. Our usage per unit, we have been given in the question under the standard cost card, 6 kgs. This is 6 kgs. And this is 4 kgs per unit. We multiply by the actual production. Actual production is given there of 19,000 in note number 2. 19,000 actual production. 19,000. So that now we can compare with the actual material, 98,000 and then 50,000. Such that if we do our computations, we'll discover that material A, 6 kgs times 19, should have been 114. We should have used 114 kgs, but we used only 98. This is a good thing, that we have saved 16,000 kgs multiplied by 15 shillings. This is giving us 240,000 favorable. 240,000, and it is favorable. We have made a saving. This one is 4 times 19, which we should have used 76. But we have used 50, meaning we have also made some savings. Some savings of 26,000 kgs times 3 bob. This is actually 78,000. Favorable also. That is as far as materials are concerned. We require to also do for labor, and therefore we extend. Let me just erase this part that I can extend my working. That's exactly what we have done for materials. We're just putting them together in a format that the results can be used to do reconciliation. So we have number 3, which is labor rate variance given as actual hours in bracket standard rate minus actual rate. We have one type of labor, so we can just substitute the actual hours, and they have been given in note number 2 just before required. If it is 1 hour is 10 shillings and you have spent a total of 700,000, that means the 70,000 should be the hours. The standard rate is given up there as shillings 9 per hour, 9 shillings, but the actual is 10 shillings per hour, meaning we have spent some 1 shilling over and above. This is 70,000, which is adverse. We have spent more. Now, the fourth one is the labor efficiency variance, which is the standard rate in bracket, standard hours minus actual hours, where the standard rate is the 9 shillings, but the standard hours is just determined by means of going to the standard cost card. We see how many hours we had budgeted to use per unit. It was 5 hours to be used per unit. We multiply by the 19,000 units that actually we produce. Then we compare with the 70,000 hours that we used. By comparison, we find that 5 times 19, these actually should be like 95, if I'm not wrong. Let's see. 5 times 19, this is exactly 95 hours. We were to use 95, but we have used 70. That means we have saved 25,000. 25,000 multiplied by 9, this is giving us 225,000 favorable. We have 225,000 favorable. That's all about labor, and that's what you have done already previously. Then we come to number 5. Now, we would have gone to the variable overheads, but this question doesn't have the variable overheads. So we just go straight to the fixed. Now, the fixed, we go to fixed overhead expenditure variance. Now, remember, in the fixed, we did several of them. But only one is required to do reconciliation because we don't vary the fixed. We only need one. Remember, material you have used 2, material price and usage. Labor we use 2, labor rate and labor efficiency. But for the fixed, we only use 1, which is fixed overhead expenditure variance, which is budgeted fixed overheads minus actual fixed overheads. In our case, the budgeted fixed overheads has been given in note number 1. 90,000 is what we were to spend. But we have actually spent in note number, just before required, we have spent 86,000. Meaning we have saved some 4,000. Is favorable. We have saved 4,000 shillings. That's all about fixed. We don't need any other. So in fact, we are through with all the variances for cost, material, labor, and fixed. We don't have variable. So we go to the income variance, which is the number 6 here, sales price variance, which is given as the actual quantity. The formula is the same as that of material price. So you have actual quantity in bracket actual price minus the budget price. We just compare the two prices. The actual quantity, this is now not materials, but what we are producing and selling. We are producing and selling 19,000, and we are selling for a price of 150, while the budget price should have been up there 160. Meaning we have lost 10 shillings. 10 shillings, this is already 190,000. This is adverse because we have lost. Adverse variance. If we are to do number 7, the selling or the sales margin variance, volume variance, sales margin volume variance, this one should be the budget margin in bracket the actual quantity minus budget quantity. So where the budget margin, of course, it is what we have done there. So remember, the budget margin is actually the budget price minus the budget variable cost, which is 160 budget price. But these others, when you add them, 90 plus 12 is already 102. You get 147. This is already 13 shillings. So you come and have here 13 shillings is the budget margin. Multiplied by the actual quantity is 19,000, but we should have produced and sold 20,000. Therefore, we have lost 1,000 units. 1,000 times 13 is already just 13,000. 13,000, which is adverse, this adverse variance. And that is all. Now, one thing to note is that these have given sales price variance, which is also the same as saying sales margin price variance, because it would have been actual quantity. Then you have the actual margin minus the budget margin. Remember, the margin difference and the price difference is the same, because even the actual margin would be the same calculation, only that here we use actual price, but the budget variable remains. So therefore, it's like saying that this is units are 19,000. The actual margin should be the actual price of 150 minus 147. That is going to be 3 bob only. 3 shillings minus this is 13 already. The difference is only 10 shillings, just like here it's 10 shillings. This 10 shillings. So the answer would still be the same, 190,000 adverse. So therefore, I told you in advance in the other lesson that the price and the margin would give the same as long as it's price variance or price margin price variance. But for the volume, it must be considered margin, but not the price. So with that, we are through. We have done all the variances. So in that case, we need to get now the actual profit here. So this is actual profit. Now, we add all the favorables and we less the adverses. For example, if we add from up here, we have 170,000. We add the 220, 500. We add the 5,000. Then from there, we add also the 240,000. 240,000. We add 78,000. Then we come and subtract 70,000. We add 225,000. We add 4,000. We subtract this 4,000. We subtract 190,000. and we subtract 13,000. This should give us 669,500 as the variance, as the total profit. You see the budget was 170. You can see our actual is 669. This means so high. What is it true? Can we prove that it is true that the actual profit is this 669? We do have in information number 2. We do have, this is we can have the proof. The proof. The sales, this is actual sales. Actual sales, we do have 20,000, 19,000. This 19,000, each at a price of 150. Then we less. We are going to less the material cost. Material A, material B. We have labor costs. And you have the fixed overheads. The material A is already a cost of 1249,500. Material B is 145,000. Labor is 700,000. Fixed is 86,000. So the sales as provided, we have it as 19,000 multiplied by 150. This is a 2,850,000. If you subtract all this, so minus 1249, so we have so 1249,500 minus 145,000 minus 700,000 minus 86,000. Exactly, is giving us a total of 669,500 as the net profit. This is now the net profit. This is just proving. It's not a must for you to do this in an exam, but as long as you got your answer there. So this is just my own. I've proved, and I've proven that for sure what you have done is very correct. Starting from the calculation of the budgeted profit, coming to the variances, material, price, and usage. Remember, don't forget this. We have been consistent with the formulas and how we are substituting. How to substitute also the labor variances, labor rate, and labor efficiency. We don't have variable overhead in this question. Then you have a fixed, only one required, not all the rest. We have the sales variances, there are 2 of them, the price and the volume variance. Remember about the volume is about the margin, budget margin, and budget margin you get by taking the price, you subtract the budget variable cost, which you get 13 shillings, multiply this one, and as you multiply this one, you're going to have your 190,000 adverse, then, you're going to have your 13,000 adverse, then all that you're able to get your actual profit. Remember, taking the budget profit, you add the favorables, you subtract the adverses. The figure you get here is your actual profit, and I have made a proof there, and everything is correct. So we are through with the variances. The first part of variances and also reconciliation. So lesson 5 shall be advanced variances, the material variances and the labor variances in terms of mixed variance and the yield variance, mixed variance and yield variance, and that will be all about this topic. That's all for now. Please do more practice. Variances are not difficult. Do more practice. Use what I've shown you. Be consistent. Do not just pick figures, just combine them, multiply them. No. Be logical enough and everything will be very okay with you. Otherwise, that is what I'm advocating for. More practice. And I wish you all the best. God bless you.
Enroll your child for the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a course-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
Hello candidates, welcome to our today's financial accounting lesson. The topic is financial statements of a manufacturing entity. In our last lesson, we learned how to treat the manufacturing profit, how to record the manufacturing profit. Remember, we say that there are some companies that have a policy of releasing the finished goods from the factory to the warehouse at the market value, which is the cost of production plus the profit, what we called the manufacturing profit. In our today's lesson, we want to learn how to treat the unrealized profit in the books of a manufacturing entity. So the topic is financial statements of a manufacturing entity. Financial statements of a manufacturing entity. And the subtopic is treatment of unrealized profit. Unrealized profit. How do you record unrealized profit in the books of a manufacturing entity? Before we consider the treatment, you need to understand what's the meaning of unrealized profit. Unrealized profit is a profit that has not been realized. Profit that has not been realized. When a manufacturing firm releases its finished goods from the factory to the warehouse as finished goods at the market price, at the market value, meaning production, that is market value. The market value of goods is equal to the cost of production plus the manufacturing profit, So goods in this case would be valued at the market value, which means incorporated in this value is a profit element, so that at the end of the accounting period, if you have stock of finished goods, if there are stocks of finished goods, then that would mean that the profit, because the purpose for producing goods is to sell. Profit is only realized after sale. After there is sale of finished goods, that is when profit is realized. But at the end of the accounting period, if the company still has stock of finished goods in the warehouse, then it means that there is what we are referring to as unrealized profit. There is profit that has not been realized because the stock of goods are recorded at the market value. So we want in our today's lesson to learn how to treat this unrealized profit in the books of a manufacturing entity. So, unrealized profit occurs where, learners, unrealized profit occurs where it's the policy of a firm, it's the policy of the company to value stocks of finished goods, to value stocks of finished goods at the market value or the selling price rather than the cost, so that the difference you can write the difference between the market value and the cost of finished goods, the cost of finished goods is the unrealized profit, that difference between the cost of goods produced and the market value or the selling price of the goods, that would constitute the unrealized profit. I want you to write another sentence. The difference between the unrealized profit, on the opening stock of finished goods, and the unrealized profit, and the unrealized profit on the stock of finished on the opening stock. This is the unrealized profit on the closing stock. The difference between the two, the unrealized profit on the opening stock, the difference between the unrealized profit on the opening stock and the unrealized profit on the closing stock should be charged to the profit and loss account. That is one treatment. Remember, we've talked about, we are learning how to treat unrealized profit. Now we are learning how to do the financial statements of a manufacturing entity. So, treatment of unrealized profit in the profit and loss account. This is a financial statement. Okay, how do you record unrealized profit in the financial statement, which is the profit and loss account? So, one treatment is that the difference between the unrealized profit on the opening stock and the unrealized profit on the closing stock, the difference should be charged to the profit and loss account. That is one treatment. Then another point, the provision on the unrealized profit, on the closing stock at the end of the accounting period should be subtracted from the market value of finished goods at the end of the period in the balance sheet. I repeat, the provision of the unrealized profit on the closing stock at the end of the period should be deducted from the market value of finished goods in the balance sheet at the end of the accounting period. That's another treatment of unrealized profit in the financial statement, which is the balance sheet. So the unrealized profit affects both the income statement and the balance sheet. In the balance sheet, I've just said, the provision for unrealized profit, the provision for unrealized profit, on the closing stock of finished goods at the end of the accounting period. End of the accounting period should be deducted or subtracted from the market value of finished goods, goods in the balance sheet. Balance sheet statement of financial position. That is how the unrealized profit affects the financial statements, which is the balance sheet. We also stated how the unrealized profit affects the profit and loss account, which is also a financial statement. Before we do an illustration, let me demonstrate using fictitious figures or symbols. So the first financial statement is a profit and loss account. We've said that the difference between the unrealized profit on the opening stock of finished goods and the provision of unrealized profit on the closing stock. Okay, so here we have unrealized profit account. This account ideally should have a credit balance. So the balance at the start, balance brought down, you can have balance brought down there, then balance carried down at the end. The balance carried down at the end, ideally this account, the balance carried down on unrealized profit should be on the debit side. So the difference between these two, balances, and the difference can either be on this side or on this side, depending on the values. The balancing figure can either appear on the debit side or on the credit side. If the balance appears on the credit side, then it means this is an increase. Okay? This is an increase in the provision for unrealized profit. This is provision for unrealized profit account. So if you have a figure of, say, 10 million, and at the end here you have a balance of, say, 15 million shillings. So assuming we have these two, then the balancing figure will appear on the credit side, and it will be 5 million. So this is an increase in provision for unrealized profit. So this increase in the provision for unrealized profit, the double entry, since we have credited this account, then the double entry will appear here. We'll have 5 million appearing there. This is unrealized profit if there is an increase. But at times you may have a decrease from, say, the 10 million. You may have a decrease here of, say, 7 million. So you see the balancing figure will appear on this side of 3 million. So the double entry will be to debit the provision for unrealized profit and credit the profit and loss account, unrealized profit 3 million. So where there is an increase in provision for unrealized profit, then since we are recording on the debit side, we record it under the other expenses. So this becomes an expense, like an expense. But where there is a reduction in the provision of, say, the 3 million, you see we are recording it on the credit side. And if you are recording it on the credit side, you see we are recording it on the side of the gross profit. So it's like an income. So candidates, you don't need to memorize the double entry. Just understand the double entry. If you are debiting this side, then since you are debiting, double entry rule dictates that for every debit entry there must be a corresponding credit entry. So the corresponding credit here is to credit the profit and loss account, and where there is an increase, the corresponding debit entry will be to debit the profit and loss account. So having understood the treatment of unrealized profit in both the profit and loss account and the balance sheet, we can now have an example. Can we now illustrate? I read this question. It's a past paper question. The following balances have been extracted from the books of Limuru Manufacturers, a small-scale manufacturing enterprise, as at 31st December 2002. So we have the balances there. Balances. Stocks are shown, raw materials, work in progress, finished goods. Purchase of raw materials is also shown. Direct labor, factory overheads, both variable and fixed, administrative expenses, rent and rates, lighting, stationery and postage, staff salaries. Then there is sales down there of 192 million, plant and machinery at cost 30 million, provision for depreciation 12 million, motor vehicles for sales deliveries at cost, that one is for sales delivery. That means that the motor vehicle is not meant for the factory but for sales. Then we have creditors, debtors, drawings, balance at bank, capital on 1st January 2002, provision for unrealized profit as at January, we have it there, motor vehicle running costs. Additional information number 1, stocks as at 31st December 2002, raw materials, work in progress, finished goods. Number 2, the factory output is transferred to the trading account at factory cost plus 25% of factory profit. Then number 3, depreciation is provided at the rates shown below on original cost of fixed assets held at the end of each financial year. Plant and machinery 10%, motor vehicles 25%. Number 4, amounts accrued at 31st December 2002 for direct labor amounted to 3 million, and rent and rates prepaid at 31st December 2002 amounted to 2 million. Required manufacturing, trading and profit and loss account for the year ended 31st December. Then number 2, the balance. Part 2, balance sheet as at 31st December 2002. So that is the question. So we are required to prepare the manufacturing, trading and loss account for Limuru manufacturers. So I'll have illustration. We want to illustrate unrealized profit, but we want to use a complete question. This is a past paper question. The name of the company, Limuru manufacturers. We want to prepare the manufacturing, trading and profit and loss account. Trading and loss account for the year ended 31st December 2002. So I'll have 2 columns. We can have them in thousands. Yes, in thousands. So we will first do the manufacturing account. Now the manufacturing account helps us to determine the cost of production, cost of manufacturing, and in this question we told that the company releases goods from the factory at a markup of 25% on the cost of production. So we'll first do the cost of production, then we'll add the profit to get the finished goods, the market value of finished goods. So let's start with the cost of raw materials. Cost of raw materials will have this is the cost of raw materials. Cost of raw materials, we have the opening stock, the opening stock of 7 million. We'll add purchases of raw materials of 38 million. Then we will get these two 0, 0, 0. We have 5, 4. Then we less closing stock. The closing stock of raw materials. Closing stock of raw materials 9 million. 9 million. Deduct. This will be equal to 636 is the cost of raw materials consumed. Cost of raw materials consumed. After determining the cost of raw materials consumed, we can now calculate the cost of labor. Cost of labor. Now the cost of labor is 28 million, but not number 4. Not number 4. We have accrued direct labor of 3 million. So accrued or labor in arrears we add, right? We add. So we have direct labor. We'll add 28 million plus 3 million to get 31 million. 31 million. Then we do not have the direct expenses. So we get these two. This will be equal to 67,000. This 67,000 is what we call the prime cost. Prime cost is equal to cost of raw materials plus cost of direct labor plus cost of direct expenses. Direct labor, direct expenses plus direct materials. Direct material, direct labor, direct expenses will give you the prime cost. In this question, we do not have direct expenses, but we have factory overheads. We'll add the factory overheads. Factory overheads are simply the indirect expenses, and they are grouped into two here: variable and fixed. Variable and fixed. Variable factory overheads 16 million. We add the fixed factory overheads of 9 million. Then we have depreciation on plant and machinery. Depreciation on plant and machinery, not number 3. Depreciation is provided at the rate shown below on the original cost of fixed assets held at the end of the year. The cost of plant and machinery is equal to, moving down there, below sales we have plant and machinery 30%. All right, 30%. So we'll apply 10%. That is 30 million. 30 million. Below sales we have plant and machinery at cost 30 million, and note number 3, plant and machinery depreciation on cost 10% per annum. 10% per annum. So depreciation, plant and machinery is 30 million times 10%. 30 million times 10% is equal to 3 million. To 3 million. So this total will give us the factory overheads. 16 million plus 12 million, this is equal to 28 million. 28 million. So we add the overheads to the prime cost. Overheads to the prime cost. That will give us production costs minus work in progress. Work in progress. So let me use my machine. So I'm going to add this 67 plus 28, it's 95 million. 95 million. This total 95 million. Then we'll add the opening work in progress, then less closing work in progress. The opening work in progress 5 million, 8 million. 5 million we add, deduct 8 million. So that will give us the production cost 95 plus 5 minus 8. It's 92 million is the cost of production. The cost of production, or the production cost. Cost of production. It is on this cost of production that we'll apply the 25% to get the manufacturing profit. Manufacturing profit 25% times 92 million. 25% times 92 million. This is 92 million times 25%. So the manufacturing profit is equal to 23 million. 23 million plus 92 million is equal to 115. Now, this 115 is what we were referring to as the market value. Market value of finished goods. Market value of finished goods. This is the value that will represent purchases. Manufacturing entities do not buy finished goods. They convert the raw materials into finished goods. So the value, total value of finished goods is what will represent purchases in the trading account. There are those companies which do not add the manufacturing profit to the production cost. This company's policy is to add 25% of the cost of production to get the market value. Other companies simply work with the 92, which is the cost of production. And if you remember in our last lesson, if I was to take you back, in the last lesson we talked about manufacturing profit, and we said that the manufacturing profit, the double entry for manufacturing profit is to debit. We say that we debit the manufacturing account and credit the profit and loss account. Here we are preparing these records using the vertical method. But if you are to do the horizontal method, then this is what we will have. Manufacturing account. Candidates, you'll appreciate that all these are costs. They are costs. And if they are costs, then the manufacturing account will be debited by all these costs. We have the prime cost, prime cost of 36 million. There is the direct labor of 31 million. We have the factory overheads of 28 million. This is factory overheads, which we had a total of 95. This 95 million. Then we deducted the opening work in progress, and then deducted the closing work in progress of 8 million, 5 million. So we had a total cost of production here of 92 million. Then of course the manufacturing profit. So you can see here manufacturing profit is debited on this account. The manufacturing profit is debited on this account, and the double entry will be to credit the profit and loss account. So below the other incomes, all right, below the other incomes, like the gross profit. After the gross profit here, we'll have double entry, manufacturing profit. We'll add it to this profit. That is the double entry. When we said in our last lesson that the manufacturing profit, double entry, debit, the manufacturing account, credit, profit and loss account, this is what I meant. The manufacturing profit here is debited, and the corresponding double entry is to credit the profit and loss account. Then learners, just for the sake of expanding knowledge, to expand your knowledge, this manufacturing account, you can see the balancing figure on this account, because here we'll have 15. Expanding your knowledge here a bit, this is the manufacturing profit. We added it to the cost there to get this is total of this was 23 million, total of 115 million. This 115 million, this is the total market value. This is the total market value. To close this account, we get the balancing figure of, there is a balancing figure here of 115 million. Now this 115 million is closed to the trading account. This is what now will be transferred. If you are doing the horizontal, this is what you do. If you are doing the horizontal format, we will close this 115. We not write balance carry down, but we close it to the trading account. And that is what we want to do next. We have done the manufacturing account. So this is the manufacturing account. Manufacturing account. We want now to proceed to the trading account, and as usual, the trading account, we start with the sales. From the question, the sales figure is 192 million. 192 million. So we compute the cost of sales. The cost of sales now candidates, when you are selling, you sell the finished products. So we'll start with the opening stock of finished products. Opening stock of finished goods. What is the opening stock? The opening stock is 6.9 million. 6.9 million. We'll add the market value of goods transferred, the double entry here, learners. This is the market value of goods from manufacturing. Okay, this is market value of goods from the factory. Market value of goods from the factory, 115 million. Then do we have the closing stock? Yes, closing stock. You have the closing stock. The closing stock of 10 million 350. 10 million 350 we deduct. That will give us the cost of sales. 6.9 plus 115 minus 10,350. 10,350. So I have here 11,155,5 minus 192 million. 80,450. 80,450 is the gross profit. That is the gross profit. Then we add other incomes like the manufacturing profit. This manufacturing profit, this one here of 23 million. Add 23 million. So 23 million. This is 80,450 plus 23 million. The total income here is 103,450. 103,450 is the total income. Then we deduct expenses. Expenses from the total income. Expenses from the total income. So this is total income. We'll have here expenses. Expenses, not number. The first one there is rent and rates. After the factory overheads, rent and rates is the first expense. That will need an adjustment. If you are to check note number 4, we are told that and the rent and rates prepaid at 31st amounted to 2 million. Rent and rates prepaid. So rent and rates prepaid. The amount there is 19 million. This is 19 million. We will deduct prepaid amount of 2 million. Deduct to get 17 million, which is the rent for the year. Then next is the lighting. Does not need any adjustment, so we just record the way it is there. Lighting Lighting is 6 million. Next, after lighting, stationery and postage. Stationery and postage. Stationery and postage 2 million. 2 million stationery and postage. Staff salaries. Staff salaries. Staff salaries 19,380. 19,380. Staff salaries. What else? Depreciation, note number 3, depreciation is provided at the rates of original cost, fixed assets, motor vehicles, 25%. Depreciation, motor vehicles, 25% of the original cost, which is 16 million. Times 16 million, that will give us the depreciation. 16 million times 25%, 4 million. 4 million depreciation. Then what else? What else? We've done everything apart from provision for unrealized profit. Provision for unrealized profit. This was the subject of today's lesson. So we have to open a working provision for unrealized profit account. Provision for the unrealized profit account. If you are to check, learners, if you are to check the balances, the second last item, you can see there, provision for unrealized profit as at January 2002, 1,380,000. That is a debit, a credit balance. There is a balance there brought down. Balance brought down 1380. 1380. So we need to calculate the unrealized profit at the end here. Balance carried down at the end. Then we see if the balancing figure will be an increase or a decrease in provision for unrealized profit. And how do we determine the provision for unrealized profit at the end? That is simple. We will check the finished goods at the end, and in note number 1, the finished goods is valued at 10,000. 10,350,000 is the finished goods. The market value of finished goods 10,350,000. So learners, the 10,350,000 is the market value of finished goods at the end. We need to determine the profit element. The profit element in the 10,350. This 10,350 is inclusive of the manufacturing profit. Okay, that means this is a representation of the 125%. That is 100% plus 25 will give us the 125%, which represents the market value of the finished goods. Therefore, what will be 25%? Because we are looking for this 25%. We need the 25%, which is the unrealized profit. 25% is the unrealized profit. The 10,350 is the cost plus the manufacturing profit. Because these are stocks at the end, the 25%, which is inclusive here in 10,350,000 has not been realized. These goods have not been sold. This value is overstated for the purposes of preparing the accounts. That's why when we began, we say that the provision for the unrealized profit on the closing stock of finished goods should be deducted or subtracted from the market value of goods in the balance sheet, market value of finished goods. So what is 25% here? We will have 25 divided by 125 times 10,350 times 10,350. So the balance here will be 2,070,000. So we need to get the difference between these two. Is this an increase or a decrease? So we get the difference, 1380. So you can see here there is an increase from 1,380,000 to 2,070,000. So there is an increase here which will be transferred to the profit and loss account. This is an increase in provision for unrealized profit of 690. The total here 2070. So this is an increase in provision. So I'll come here and include this increase. This is an increase in provision for unrealized profit of 690. So another expense here, learners, is the motor vehicle running cost. Motor vehicle running cost of 4,500,000. So we'll add all these expenses to get the total expenditure. 17 million plus 6 million plus 2 million plus 19,380 plus 4 million plus 690 plus 4,500. So 53,570. This is the total expenditure. Deduct total expenditure from the total income minus 103,450. So my answer here is 49,880. This is what we call the net profit. So that is the net profit, 49,880. So we can now do the part B, statement of financial position. That is part B, statement of financial position. Statement of financial position. So first we write the name of the company, Limuru Manufacturers. Statement of financial position as at December 31, 202. We'll first have the non-current assets, which will have 3 columns: cost, accumulated depreciation and net book value. The figures are in thousands. So the first non-current asset is the plant and equipment, plant and machinery. Plant and machinery. Then we have motor vehicles. Motor vehicles, 30 million, 16 million. 30 million, 16 million. The total here is 46 million. Now for the accumulated depreciation, candidates, you remember that the accumulated depreciation here, we take the accumulated depreciation at the start of the accounting period. At the start of the accounting period, what has accumulated up to the start of the accounting period, then we add the depreciation charge for the year, which appears in the trading profit and loss account. So for the plant and machinery, the accumulated depreciation from the balances is 12 million. We add the depreciation on plant and machinery, which in this case constituted part of the factory overheads. So part of the factory overheads, we had depreciation on plant and machinery of 3 million. So 12 million plus 3 million is equal to 15 million. All right. Then for the motor vehicles, the accumulated depreciation on motor vehicles up to the start of this accounting period on 1st of January. This information has to be provided in the question. We've been told that the accumulated depreciation at the start was 4 million. Then if you check the trading profit and loss account, the depreciation charge on the motor vehicles for the year was also 4 million, giving us a total of 8 million. So this is accumulated depreciation, 23 million. So we get the difference between the cost and the accumulated depreciation to give us the net book value. So the net book value on plant and equipment here is 15 million, and for the motor vehicle is 8 million, giving us a total here of 23. This is 23 million. That is the non-current assets. Then we add current assets. Current assets will constitute the cost of the stocks. These are stocks. In this question, you have stocks of raw materials. We have stocks of work in progress. We have stocks of finished goods. So the stock of raw materials at the end, 9 million. The cost of work in progress, 8 million. Then you have the cost of finished goods. Under additional information, we are informed that the cost of finished goods is 10,350,000. 10,350,000. Candidates, remember when we began this lesson, we said that the provision for unrealized profit at the end of the accounting period, provision for the unrealized profit on the finished goods at the end of the accounting period should be subtracted from finished goods. Provision for unrealized profit at the end, and we have just calculated it here. Provision for unrealized profit at the end of 2,070,000 should be deducted. 2070 should be deducted from the finished goods, because these finished goods, which are valued at 10,350, is inclusive of the unrealized profit. So that provision for unrealized profit at the end should be deducted from this finished goods to get the cost of finished goods, because the finished goods are always, goods or inventory is always valued at cost. Okay, must be valued at cost. So we will get the difference of 10, this is 10, 350 minus 2070 is equal to 2,080,000. So that is the cost of materials and work in progress and finished goods. Then we check for any other current assets. We have debtors amounting to 28 million. Next we have cash at bank of 16,600,000. 16,600,000. Then remember the prepayment 2 million. Prepayment 2 million. Then do you have any other current assets? No. So let's add the current assets starting from 9 million plus 8 million plus 8280 plus 28 million plus 16,600 plus 2 million. This is equal to 71,880. We add to the 23,600 total assets 95,480. Total assets. These total assets are financed by liabilities and capital. Liabilities and capital. Do you have liabilities? Do you have liabilities? Yes. Creditors. You have liabilities. One creditors of 5,500,000. Then we have accruals. Accrual and additional information, we have accrual of 3 million, giving us a total here of 8,500,000. Then we have the capital. The capital there is capital is 48 million. The net profit, you can have it this side. Net profit. Net profit. So then you have the two columns. I have the net profit from the trading profit and loss account of 49,880. From this question, you also have drawings amounting to 11,500,000 deduct. So we can now add liabilities and capital, starting from the current liabilities of 8,500,000 plus the capital, this capital 48 million. Then we add net profit 49,880 Then we deduct the drawings, 11,500 is equal to 94,880. 94,880. So this is the total liabilities and capital. 94,880, which should be equal to 94,880 here. 94,880. This is 23. It's 23. Should be 23. It's 23 million plus 71,880. 880 is equal to 94. This is equal to 94,880. 94,880. Total liabilities plus and capital must be equal to total assets. So candidates, we've come to the end of our today's lesson where we learned how to treat the unrealized profit in the accounts of a manufacturing entity. We saw that the unrealized profit affects both the income statement and the statement of financial position. We said that the difference between the two, that is the provision of the unrealized profit at the end of the accounting period on the finished goods, and the provision of the unrealized profit at the start of the accounting period, as demonstrated in this account. The provision between these two, the difference between these two at the start and at the end, at the start and at the end, the difference should be charged to the profit and loss account. And we say the difference may either appear on the debit side or on the credit side. If it appears on the credit side, then it's an increase in provision, which should be treated as an expense. If there is a decrease, which will appear on the debit side, then the corresponding double entry will be to credit the provision, the profit and loss account, and that will be like an income to the entity. That is how we treat the unrealized profit in the profit loss account. As for the balance sheet, I have just demonstrated here the balance sheet. We need to deduct the balance carried down on the unrealized profit at the end. This balance at the end is what we deduct from the finished goods, because the finished goods of 10,350,000 includes the profit that has not been realized. This is the market value, and we know, according to international standards, the inventories must be recorded at cost or net realizable value, whichever is lower. That's why we have to deduct this profit element that has not been realized from the market value of finished goods at the end to arrive at the cost, which must appear, which is supposed to appear or reflect in the balance sheet. So that is how we treat unrealized profit. Thank you, learners. Thank you for those who are asking questions. We will continue to answer all your questions. Below this video, there is a comment section where you can post your questions and your questions will be answered. For now, learners, I will send you to the financial accounting revision partner. We have very many questions here for you for your practice. Go to the topic on the financial statements of a manufacturing entity. There are enough questions for your practice. Here we have assembled 12 questions on manufacturing accounts. Go and practice. If you have any question, ask, attempt the question, mark your work, because answers are provided at the back of the book. Thank you and bye-bye.
Enroll your child with the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a course-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
Hello my dear learner. I welcome you again to another session where we'll be continuing with our discussion on the components of the business plan. In our earlier sessions, we did discuss some of the components of the business plan, starting with the title page, the table of contents, the executive summary, the business description, marketing plan, and the management or organizational plan. So in our today's lesson, we will look at the remaining components of the business plan, which are 3 components. And they include the components operational, also known as production plan, financial plan, risk management plan, and appendices. Operational plan, which is number 6. Number 6. Operational or production plan. Again, this component of the business plan represents another function in the business, which is the production function or operation function. So a forecast of the operation or production function. Operational processes in an organization are concerned with the processes of making available goods and services. They relate to all the activities undertaken in the process of making the products, whether goods or services. Traditionally, operations was used in connection with service industries, and production was used in connection with industries or firms that are producing goods. But today, the universal acceptable term is operations, defining all those activities that are concerned with the production of goods or services, whichever the case. Now, the operation component of a business plan describes the operational activities and all other processes involved in making available goods and services to the consumer. When you look at the operation function, it is concerned with, most importantly, the technology to be employed, so that organizations will seek to employ an efficient and effective technology. It is only that way that they will have a competitive advantage. Again, other than the technology to be employed, there is the machinery and equipment employed in that processes, which is also part of the technology, because the machinery and equipment will be of a certain technology. And other than the machinery and equipment and the technology, there is also the operational activities or strategies, whichever the case, relating to the inventory management processes, quality control processes, and issues to do with work planning. So the contents, before that, we said that this component, the component describes all activities involved in making available goods and services. The specific sections will cover the following contents. The first one is operational objectives. Operational objectives, which are simply the aims of the operation function. The operation function. What would be the desired aims of the operation function? In operations, we seek to reduce costs. We seek to achieve efficiency and effectiveness. We seek to achieve increased output. Operations also seek to achieve flexibility in terms of production processes. So functions or objectives under these functions will include, among others, cost reduction, timely fulfillment of orders, increased speed of production, increased speed and output, improved product design, among others. Improved product design, among others. Now, these operational objectives will be supported by what will appear under the other sections of the operational or production plan, so that the next section will describe the production facilities. In regard to production facilities, the main areas of concern are factory layout, machinery or production, plant and machinery, production plant and machinery, then we also have machinery and plant and machinery in regard to cost, capacity, economy, etc. The third section, or the third item making up the operational plan, is the operational processes. Now, operational processes are aimed at enhancing efficiency and effectiveness by or through reduction of costs and specialization. And the main items that will be captured under this section will include quality control measures, purchasing decisions, inventory management processes, among others. We again have a fourth component, which is operational strategies. That is the approaches. Operational strategies. The approaches to be employed. Approaches and techniques. To be employed. And specifically, of concern to the operational strategies will include, among other things, the processes of production scheduling, that is planning for production, the laws and regulations affecting operations such as insurance, safety, and sanitation. We also have quality control issues in the organization, as well as the technology to be employed. The form and the type of technology to be employed is an important operational strategy because it influences what the organization can achieve in terms of production and improvement of production processes. So essentially, these are the sections that will appear under the operational or production plan. This takes us to the next component of the business plan, which is the financial plan. Financial plan. Again, the financial plan is a representation of the finance function of the intended business. A representation of the finance function. The finance function of the intended business. Intended business. It discusses or describes three main things. The capital requirements. It projects the capital requirements. Or business capitalization. Business capitalization. It also predicts or forecasts the expected profitability of the new business, expected profitability, and again, it also captures the expected activity level. In terms of output or quantity and the value of sales. And the value of sales required so as to be able to cover costs of operation. Now, what are the specific items that will be captured under the financial plan? This is the component that becomes the basis for financing. It is the amount of capital projected in here that the bank will be considering to advance or not to advance, and the justification of the amount that the entrepreneur is asking for. So, among the contents, the first section captures the pre-operational costs. So, a forecast of pre-operational costs. The amount of expenses that the entrepreneur is likely going to incur before starting operations, used for purposes of registration, acquisition of licenses, securing a premises in terms of rent or leases. So all these costs are going to be determined because they will make part of the loan or the capital that the entrepreneur will be seeking. Coming second under that component is a forecast of operational costs. This forecast is going to be given on a monthly basis for at least a period of 1 year. So the costs of operation for every month will be provided on a monthly basis. For at least 1 year. Then coming third, or the third section, will be the desired financing. This is the total capital required to implement the idea, and the desired financing is in terms of amounts and type. That is whether equity or debt. Whether the entrepreneur is going to raise that money by issuing shares, or whether they desire to take a loan, or they need a proportion of both. It will be indicated in here. Coming for is a forecast, a projection, or a projected statement of cash flows. Now, the entrepreneur will present in here statements of cash flows for at least 1 year on a monthly basis. So on a monthly basis, the usefulness of this cash flow is that the entrepreneur, even before starting operations, they will be able to tell what would be their liquidity needs for the entire period of 1 year. This is important because for an entrepreneur to operate smoothly, or the business operations to continue smoothly, the business needs to be liquid, so that it doesn't have challenges buying or restocking. It doesn't have challenges paying pre-operational expenses, meeting legal obligations such as interest on loans. Otherwise, that would get the entrepreneur in a lot of trouble in the very early years or months of operation. Coming right after the cash flow statements is a projected balance sheet, projected profit and loss accounts, Again, these ones will be for at least 3 years. Here the entrepreneur projects the expected profitability of the intended business for the first 3 years. When the business or the bank manager, he is considering whether to advance or not to advance the money, they will want to know the expected profitability of the business, particularly for the first 3 years. That will inform them on whether this business is good enough, whether the idea is attractive enough to be able to generate enough revenues, enough profits, and consequently be able to settle the debt or pay the debt without default or failure. Then the next section is going to be, contain projected a statement of our balance sheets or statements of financial position, projected balance sheets, again for at least 3 years. 3 years. In here, the entrepreneur again will be presenting the composition of the capital base, the assets that the business intends to own, and the specific sources of financing and their composition. It is important that the company is properly geared through a balance of loan and debt, because that reduces the level of indebtedness of the business, making it easier to pay loans. Coming after the projected balance sheet is another section that will describe the break-even analysis. Now, the break-even analysis is going to depict the expected activity level in terms of output and sales revenue that will enable the business cover its costs of operations and thereby break even. This shows whether the expected activity level is too high for the new business to meet or to achieve, or whether it is within the reach. So the break-even analysis shows the expected activity levels, and if it's realistic for the business to meet. This is particularly important to the financier, because again, if the business is not able to meet that level of activity, it means it may be making losses for a considerable period of time, making it very hard for that business to pay its loans. And coming last under the financial plan is the ratio analysis. And a ratio analysis tries to break down the information provided under the projected balance sheets together with that provided in the profit and loss accounts. As presented over successive periods, the two statements, that is the balance sheet and the profit and loss accounts, will not provide a lot of information, because it is important for an analyst to tell whether, as projected, over the successive period of time, the business will be experiencing any improvements, any increase in activity levels, any improvement in profitability level, any improvement in asset state. That is the most important information. So ratio analysis tries to break down, tries to quantify meaningful trends as depicted by the balance sheets for the successive period of time. And this is the most useful information in telling whether this business has good prospects or it doesn't. Having covered the financial plan, the next component, which is a short one, is the risk management plan, coming as the second last component. So we now focus on the risk management plan. It is interesting to note that all what is going to be covered under the risk management plan was a subject of our discussion earlier when we were looking at entrepreneurial orientation or entrepreneurship orientation, where we discussed risk management as a competence extensively. So the risk management plan Risks are the greatest threat to any business, and they are equally the greatest threat to financiers and other potential investors. Investors will be wary to commit their resources in a business that doesn't manage risks effectively. So within the business plan, an entrepreneur attempts to deal with potential risks that may face the intended business by having a well-managed, by having a well-structured approach to managing risks that are likely going to face the kind of business. So this component of the business plan identifies the key risks, the main threats of loss to the business, and goes further to come up or devise the most appropriate risk management treatments to deal with these risks in the event they arise when the business starts operations. So the risk management plan is a component that describes the potential risks the business is likely to face and the strategies that the entrepreneur intends to put in place or intends to use to deal with these risks when they arise. So describes the risks that are likely to face the business or to face the new business and an elaborate plan to manage the risks in the event they arise. So importantly, the list of risks are going to appear here, and two, the risk management techniques, better known as the risk statements, will also be clearly described within the risk management plan. The last component of a business plan is appendices. And please note that appendices is plural, so that one is an appendix. Appendices are many. One is an appendix. Now, appendices are going to appear as the last item or element in the business plan. And to append in English means to attach. So that appendices are any other detail or vital information that is supportive of the content contained in the main body of the business plan. The nature of this information is that it is either too detailed to affect the smooth flow of the main body of the business plan, or it is technical and complex in nature, so that by putting it within the main body of the business plan, it might distract the reader of the document. So we are defining appendices as attachments or any additional information. Attached at the back of the document. which is either too detailed, or technical. To be included in the main body, of the document. So how do we trace an appendix to the part of the main body where it belongs? These appendices are clearly referenced within the main body or within the main body of the document. I will use an example of an automatic appendix in a business plan, which is the map of the business location. So business location is going to appear under business description. It will be one of the sections under business description. So that under business description, we will have the section on business location. So the entrepreneur describes in wording where the business will be located. But then again, for purposes of someone who may not have an understanding of the particular location described in wording, they may want to be assisted by way of a diagrammatic representation of where that location is. So after the description of the location, the entrepreneur will reference or will refer the reader to the particular appendix that contains the map of the business location. So they will indicate in brackets within the main body, refer to appendix 1. So at the back of the document, numbered appendix 1 will be the map of the business location. So the reader, if they could not understand where the location or the location being described, then they will go to the back of the document, look at appendix 1. Therein, they will find a map of the business location. So other than the map of the business location, what other attachments will make up the appendices? Other information or detail making part of the appendices will include examples, market research data, most likely questionnaires that the entrepreneur was using to collect information from the market. We can also have layout or factory layout, products, drawings of the products, work schedules, organizational charts, among others. And this effectively will be the last element or component of the business plan document. You realize this will be a big document, a voluminous document, because this is a lot of content, and thereby we will expect that the business plan is a full blueprint. With a business plan now, the entrepreneur is ready to proceed and start implementing the idea, because everything that they need to do now is clearly stipulated is clearly defined and provided for within the business plan document. The entrepreneur will just be referring to the business plan for guidance on what they need to do, when they need to do it, how and who needs to do it. Effectively, this brings us to the end of the topic, business planning. Thank you, and see you in our next lesson.
Enroll your child with the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a course-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
Professionals are constantly in a frantic race for the best paying jobs. Equipping yourself with the best book provides you with a pool of knowledge that can launch you into the position of your dream. For the last 12 years, Manifested Publishers has been providing well-researched study materials that are packed with rich content, accurate and updated constantly to conform to the latest syllabus. These study text and revision partners, by a team of experts led by Sagwa Philip Ndeda, cover Kasneb courses like Certified Public Accountants, Certified Secretaries, Accounting Technicians Diploma, Certified Accounting and Management Skills, and Certified Investment and Financial Analyst. Order your copy online today at www.manifestedpublishers.com or call 0724 173 845 and we will freely deliver to your town in 24 hours. For Nairobi residents, visit our bookshop at Pioneer House, 3rd floor, opposite Fire Station, Tomboya Street. We open from 8 a.m. to 8 p.m.
Thank you, friends, for joining me once again. I'm your host, none other than Spotter Fred. Now, from our previous sessions, we have been discussing on consolidation matters. Now, friends, this session is more advanced. If you have not been following up from the first session, second and third and fourth like that, then you cannot join me now to understand it. It may be a little bit complex. It's important for you to understand the flow. It's important that you also understand from lesson 1, lesson 2, lesson 3, and that way you'll definitely understand it better. Now, our most recent session, we talked about disposal of shares. We looked at a scenario whereby the holding company in between the year will decide to dispose of shares in a subsidiary. That case 1, the former subsidiary may remain to be a subsidiary, meaning they don't lose control. Maybe it was 90%, they dispose of shares, it comes to 60%. Still, it will be a subsidiary. Case 2, where the former subsidiary now becomes an associate immediately after disposal of shares. Case 3, the former subsidiary becomes a simple investment. Now this case 2 and 3, they almost behave the same way. And case 4, where the holding company will dispose the entire shareholding in a subsidiary. We call it discontinued operations. That's IFRS number 5. Now we want to look at an illustration. We looked at those examples and how we account for them, the accounting treatment to that effect. So we want to now discuss an illustration, a practical example. The example I have here, friends, is an example where the former subsidiary became an associate after disposal of shares. Now, I can read it. It's a question that was examined in December 2012, but we have modified it. It has been modified so that it can suit the current situation. Unga Limited, a company quoted on Securities Exchange, acquired 80% of Shika Limited several years ago. On 1st January 2016, Unga Limited sold a half of its investment in Shika Limited and acquired 75% of the equity shared of Shujaa Limited. The financial statement for the year ended 30 June 2016 for the three companies are as given below. So remember, we have been given three companies from the word go: Unga, Shika, and Shujaa. We have been told from the word go that Shika was acquired long time ago at the tune of 80%, while Shujaa was acquired during the year and it was acquired to the tune of 75%. And during the current year, they decided, the holding company Unga decided to do away with Shika and at the same time acquire Shujaa. Very important, we're going to come back to that again. We have been given the statement of comprehensive income, as usual: revenue, cost of sales, gross profit, other incomes, expenses, distribution costs, admin costs, finance costs, profit before tax, income tax expense, profit after tax, dividend paid, retained profit for the year, retained profit brought forward, retained profit carried forward, statement of financial position as of 30 June 2016, non-current assets. We have the property, plant, equipment. We have investment in Shika Limited. We have investment in Shujaa Limited. We have the current assets. There is inventory. There is receivables. There is cash at bank. There is ownership capital, retained profit, retained profit, shareholders funds. We have the shareholders funds. We have the non-current liabilities. We have the 10% loan stock. We have the current liabilities. We have the trade and other payables. We have the current tax. We have the total capital liabilities. Additional information. 1. Unga Limited had acquired its shareholding in Shika Limited for 2.4 million when the retained profits of Shika Limited amounted to 1,500 million. There was no fair value adjustment at the time of this acquisition. 2. Unga Limited sold a half of the investment in Shika Limited for 1,500 million. This disposal has already been accounted for by Unga Limited, but not by the group. The fair value of the remaining investment in Shika Limited was 1,300 million on the date of disposal. 3. Between 1st January 2016 and 30 June 2016, Unga Limited sold to Shujaa Limited goods worth 500 million, reporting a profit of 100 million shillings. A half of these goods were still in the inventory of Shujaa Limited as of 30 June 2016. 4. Intercompany receivables and payables were as follows as of 30 June 2016. Due from Shika Limited to Unga Limited due 200 million. Due from Shujaa Limited to Unga Limited 300 million. 5. As at 1st July 2015, a half of the goodwill of Shika Limited have been impaired. The goodwill of the companies were not impaired in the current year to 30 June 2016. The group uses the partial goodwill method when preparing the consolidated financial statements. Required: A. Group statement of comprehensive income for the year ended 30 June 2016, and B. Group statement of financial position as of 30 June 2016. Now, what we have not mentioned there from the required, but we'll have to prepare it, is a group statement of changes in equity. It's important to prepare that, but it's not a must. We can just prepare the group statement of comprehensive income and the group statement of financial position. Now, from the required point of view, friends, our financial year begins on 1st July of one year and ends on 30 June in the subsequent year. So that means that the current year, the current financial year, begins on 1st July 2015 and ends on 30th June 2016. Now we go back to the question first again. From the beginning, we have been told that Unga Limited had acquired Shika Limited to the tune of 80%. But now, come to 1st January 2016, 1st January 2016 up to 30 June 2016, those are 6 months. So in the current financial year, at the end of the first 6 months, we have been told that Unga Limited sold a half of the investment in Shika. So if they have sold a half, it was 80%, they have sold a half, then it means that we are remaining with 40%. This is what we are saying. Remember, we are looking at disposal of shares, illustration. This must be illustration 6, whereby we have, this is Hunga, there is Shika. It was 80% ordinary shares. That is before disposal. But after disposal, we have Shika. Now we have disposed a half of it, this. So 80% times a half. So we have 40%. So this was a subsidiary. But after disposal now it becomes an associate. So that's the position. So before and after it becomes an associate. We have also been told at the same date, the Unga Limited acquired Shujaa Limited. So Shujaa, so the after disposal and acquisition, now we have Unga, which has Shika, 40% ordinary shares, and we have Shujaa, now 75% ordinary shares. So this is an associate, but this is now a subsidiary. It means that in the first 6 months, there was a subsidiary known as Shika. In the second 6 months, we had an associate and a subsidiary. But now the subsidiary this time round was Shujaa, while the associate was Shika. That's important. This means what we are going to do in our group income statement, we are going to consolidate the incomes and expenses of Shika to the tune up to the point when we dispose of. We apportion it based on the pre-disposal period. We also include or consolidate the incomes and expenses of Shujaa to reflect post-acquisition period only. So 6 months, 6 months. At the same time, we have to recognize the group share of the profit after tax in an associate. That's going to be interesting. Fine. Then we have been given the statement of comprehensive income. This means we are going to recognize the revenue, cost of sales, gross other incomes of Shika for the first 6 months when it was a subsidiary. For Shujaa, the second 6 months when we had acquired it. But there is other incomes. We have been given the dividends and we have been given the gain on disposal. Automatically, those dividends of 380, most likely they are dividends from Shika and Shujaa. We can confirm that because the dividend paid by Shika is 200. So if you take the percentage is 80% of 200, that is 160. But for 6 months, because it was a subsidiary for 6 months, that's divided by 2, that's 80. Then we look at the dividend paid by Shujaa is 400. So 400, we take 75% of the 400, that's 300. Now 300 plus the 80, That's 380. So it means the dividend we have there is actually from Shika and Shuja. Then we have the gain on disposal, which is 300. That's okay. The gain on disposal reported in the books of the holding company. We need to determine the gain on disposal or loss to be reported in the group accounts. We have distribution costs, admin, finance costs, tax expense, dividend paid on 30th April 2016, because the dividend was paid after disposal, so it will not participate in the computation of the gain or loss to be reported in the group accounts. We have the retained profit for the year, retained profit brought forward. So this time round we are given everything up to the retained earnings carried down. We have the statement of financial position, property, plant, equipment, investment in Shika Limited. That's the amount that we have, we may have remained with, because investment disposal was accounted for by Hunga Limited. So after disposing, what they remained with is 1.2. Shuja Limited is 1.8. That's the cost of investment. That's the purchase consideration. Will help us to determine goodwill. Current assets, we have inventory, receivables. You know, inventory will be affected by unrealized profits. Receivables, intercompany owings mainly. Cash at bank, we have it there. But we are not going to consolidate the assets and liabilities of Shika, because Shika is an associate at the balance sheet date. So we are only going to determine investment in an associate. There is 10% loan stock. There is current liabilities, trade payables, which will be affected by mainly intercompany owings and current tax. Additional information. Hunga Limited had acquired its shareholding in Shika Limited for 400 million, when the retained profits of Shika Limited amounted to 1,500 million. There was no fair value adjustment at the time of this acquisition. That one, they have given us information to compute goodwill at the date of acquisition of Shika, because we have been told that the amount we paid as a purchase consideration to acquire Shika is to 400. The retained profits at that date was 1,500. That's the pre-acquisition retained earnings. There was no fair value adjustment. That's okay. So we'll use that information to determine goodwill on acquisition of Shika that we have disposed of. Then 2, Hunga Limited sold a half of the investment in Shika Limited for 1,500 million. This disposal has already been accounted for by Hunga Limited, but not by the group. The fair value of the remaining investment in Shika Limited was 1,300, meaning it must have increased, because we had it 1,200, it has increased to 1,300. So we have an increase in fair value of 100. Then we have on the date of disposal, we have been told that note number 2 will help us to compute the gain or loss on disposal of shares in this subsidiary. 3, between 1st January 2016 and 30 June 2016, Hunga Limited sold to Shuja Limited goods worth 500 million. Now 500 million is an intercompany sale. So we are going to adjust our sales and our cost of sales by 500 million. A profit of 100 million was made. A half of the goods was still in the inventory. So a half of 100 million has not been realized. So we have 50 million, which is going to be adjusted as unrealized profits. And this is a downstream transaction, so it will not affect the non-controlling interest. Number 4, intercompany receivables and payables were as follows. So there is intercompany owings. There is due from Shika Limited to Hunga, and there is due from Shuja Limited to Hunga. The one from Shuja Limited to Hunga must be paid, because, the one from Shika Limited to Hunga Limited must be paid, because Shika and Hunga were not group members at the balance sheet date. So Shika must pay that money to Hunga Limited. But the one between Shuja and Hunga Limited are group members. It does not need to be paid. It will be eliminated. That is an intercompany owing, and it will be eliminated from the books. Number 5, as at 1st July 2015, half of the goodwill of Shika Limited have been impaired. The goodwill of the companies were not impaired in the current year to 30 June 2016. The group uses the partial goodwill method when preparing the consolidation financial statement. Fine, meaning we need to determine goodwill, and a half of the goodwill for Shika had been impaired, a half of it, but we are not impaired goodwill of Shujaa Limited. That's important. So we are going to use that information to determine goodwill. First, we determine impairment loss of the Shika Limited. We also compute our gain or loss on disposal using that information as well. Now, to begin with, let's compute the goodwill. We look at note number 1 and note number 5. We compute the goodwill of Shika. Note 1 and 5. Goodwill. Let me say, instead of saying goodwill, let's just say to determine an impaired. To be disposed. You know, goodwill is simply the purchase consideration minus the group share acquired. We can open a cost of control, but there is no need. Purchase consideration is 400 million. We had acquired 80% of the ordinary share capital. Ordinary share capital, that is 1,000 million. Share premium is not there, but we have been given the pre-acquisition retained earnings, 1,500. So what is our goodwill? I take my calculator, say 400 minus 80% of 2,500. So we have 400 here. We had impaired a half of it. So I've been told unimpaired should be a half of 400. Because if you had impaired a half, so what is remaining unimpaired is another half. Then from there, in note number 2, I think it will also help us now to compute gain or loss on disposal. So we start with the cash proceeds, which we are given. The cash proceeds in note number 2 is 1,500 million. But we have been told there is a fair value. Fair value of the remaining investment, 1,300. Then we less group share of net assets disposed. We have ordinary share capital. Ordinary share capital is 1,000. Retained earnings brought down. Retained earnings brought down is 2,500. We have disposal, PAT, the total profit after tax in this case is 700. So if I take 700, predisposal 6/12, that will be 350. So the total business here coming to, I take my calculator, that's 850. So group share will be 80% of that 850. That is 3080. Then we also less unimpaired goodwill disposed, which we got there as 200. So what is the gain or loss? The gain or loss here, friends, is 1500 plus 1300 minus 3280. So it's a loss of 480. The loss of 480. Now that's okay. We have done at least one more working. The other workings, like note number 3, is straightforward. That's intercompany sales, and there's unrealized profits. Number 4 is an intercompany owings. Number 5, we have already used it, so we need to determine goodwill. Now, working number 3. Now we determine goodwill by opening the cost of goodwill in Shujaa. Cost of control, Shujaa. Working 4, we have now investment in an associate. Shika. Working 5, we have non-controlling interest. Fine. Figures are in millions. So we bring in cost of investment. Shujaa, the cost of investment, friends, given there is 1800. And investment in an associate, cost of investment is 1200. But there is a gain. There is a fair value of 1300, so there is a gain. So there is revaluation surplus of 100. Because it was 1200, now it has gone to 1300. There is a gain of this 1300 has increased. It was 1200, now it has gone to 1300. So there is 100 increase. That's a revaluation surplus or a gain. Then we come and say, owner share capital, 75%. Our owner share capital in Shujaa is 1,000 million. That's definitely 750. We don't have share premium, but we have the pre-acquisition retained earnings, 75%. We were not given, but we could easily calculate it. 75%. What will be our pre-acquisition retained earnings? Our pre-acquisition retained earnings, we have, because we acquired the company in between the year, so the post-acquisition period is less than 12 months. That's exactly 6 months. So we know that the retained earnings brought forward, which is 1,500, the whole of it is pre. And part of the profit for the year, the retained profit for the year, which is 1,000, a half of it is pre, and a half of it is 500. Confirm that. The retained profit for the year for Shuja is 1,000 million. The retained earnings brought forward is 1,500. So we know that the 1,500, which is the retained earnings brought forward, the whole of it is pre. Then 6 months, a half of the retained profit for the year, which is 1,000, half of it is pre. So if you take 1,500, which is retained earnings brought down, that is pre, plus part a half of the profit, retained profit for the year, which is 1,000, a half of it is 500. So you take 1,500 plus 500, the total is 2,000. That means that the total pre-acquisition is 2,000. So you come and say 75% of 2,000. Leave alone that. There was also some dividend. There's some dividend that was paid. In Shuja Limited, the total dividend is 400. The group share is 75%. A half of it is pre and a half of it is post. So you must also take it into account. So we know that is 75% of the 400, which we are getting 300. So we know that a half of it is 150. A half of it, which is 6 months. 6 months is pre and 6 months is post. So you take that by 150. So we have pre-acquisition dividend, which would definitely be 75% of the 400, 6/12. And that is coming to 150. Then there is 75% of the 2,000, that comes to 1,500. So what is our goodwill? You realize that it will not be a positive goodwill. It will be a negative goodwill. It will be a negative goodwill. That's interesting. So it's not positive goodwill. It's going to be a negative goodwill of 600. This negative goodwill, the credit entry will be made to the group retained earnings account. But apart from that, we are also going to adjust the 600 in our group income statement. Then we come to investment in an associate. We bring in the group share of PAT of post-acquisition retained earnings, which definitely during the year the retained profit that we made, the profit after that we made for the year is 700, because there is 500 which is the retained profit for the year, but there is also the 200 which should be part, so the total is 700. But now the group share, which now in this case should be 40%. 40% of the 700, how much would that be? So that comes to around 280. Now 700, but for 6 months. So that's 140. Then we don't have anything else here. We don't have impairment loss. We have not been given that. So what will be the balance to be taken to the group statement of financial position as a current asset? That is 1,300 plus 140, that's 1,440. We come to non-controlling interest. We recognize the ordinary share capital, which should be 25% of the 1,000 million, that's definitely 250. We have the retained earnings. We take the 25% of the total retained earnings. Our total retained earnings as per the statement of financial position is the total retained profits in Shuja 2,500. I don't think whether we have anything else like revaluation. But I can see we have something to unrealized profit does not affect non-controlling interest because it's a downstream transaction. From that point, I don't see anything else other than that. Retained earnings. This one was straightforward, as you can see. 25% of 2,500, so 625. So the balance carried down. Group statement of financial position is 875. Now we prepare our group retained earnings account. We also do another working for the group retained earnings account. Another working for the group retained earnings account. The balances we have the balances. The retained earnings balances, there is for hunger 5,500. There is for shika 3,000. There is no, shika had been disposed of, so it's an associate. Let me talk about Shuja. Shuja first. Shuja is 2,500. Now shika, we talk about the post acquisition, which we have already debited in our investment in an associate, and that is 140. Something more that we should also bring here is the negative goodwill, which is 600. Something more that we need to bring here, there is a revaluation surplus of 100. Revaluation surplus or gain due to fair value of 100. Then from there, we now take into account cost of control, the pre-acquisition. There is what we have already transferred to the cost of control. And in that case, we must have taken, that was 75% of our pre-acquisition that we must have computed, that is 2,000. And we got a figure of 1,500. There's what we have already taken to the NCI share of retained earnings, whether pre or post, 25%. Of the 2,500, we have already credited our non-controlling interest, and that's 625. We didn't have, there is unrealized profits on stock, which we have told that a half of the total profit of 100 million has not been realized, so that is 50. If it was an upstream transaction, we could have taken the group share only, and the NCA share goes to non-controlling interest. As well, you also need to remember that the dividends we had been accounted for. The dividend which we had received from Shuja had been accounted for. And included on those dividends that we had we received from Shuja, the fact that had been accounted for, there was a pre-acquisition dividend, which we have already taken to the cost of control. That pre-acquisition dividend is not an income to the group. So it must have been included as part of the retained earnings of Hunga, 5,500. We remove it so that we can do the double entry. Remember, pre-acquisition items are not considered as an income, are considered as part of the assets, are capitalized to determine goodwill. So this dividend that we had received and accounted for, which is reported in the income statement of Uhunga Limited, there is a pre-acquisition dividend which is included the first 6 months, and we have already recognized it in our cost of control. Now, the debit entry should be done to the group retained earnings so that we can reduce the retained earnings of Uhunga. So that's what we do. There is a cost of control, pre-acquisition dividend, which we had already done. Remember, it is 75% of the 400, 6/12. And we have done that, it came to 150. Then now, we determine the balance carried down to be taken to the group statement of financial position. So we can be able to calculate this, can say 5,500 plus the 2,500 plus 140 plus the 600 plus 100. Then I subtract 1,500, subtract 625, subtract 200. So that is 6515. Now, our next agenda is to prepare. I don't have any other working that we need to do, but we need to notice that our loss was 480. There's a loss of 480, and those other items we can easily remember them. We have a negative goodwill of 600. We have investment in an associate of 1440. Then we have our non-controlling interest of 875. So then we can now clean these and prepare our group statement of profit or loss. So we come and say Unga Limited group statement of profit or loss account for the year ended 30th June 2016. We start with the revenue. We have 8,000 plus 6/12 of the 4,500 plus 6/12 of the 6,000 minus intercompany sales, which was 500. We have the cost of sales, which we have as 3,000 plus 6/12 of the 2,000 plus 6/12 of the 2,000 plus the minus 500 plus the unrealized profits of 50. We didn't have the depreciation under or overcharge. So from there, we are able to get the gross profit. So I can calculate that one first. We have the 8,000 plus plus the 3,000 minus the 500, 12,750. Then we have 3,000 plus 1,000 plus 1,000 minus 500 plus 50. That is 45, 50. Minus the 12, 750. That is 8,200. Very important. That is fine. Then we add as well, there is negative goodwill. Which was 600. Apart from that, there is a loss on disposal. You can recognize it here or later, and that is 480. Then you now less expenses. One of the expenses there, friends, is we have distribution costs. That is 1,200 plus 6/12 of the 600 plus 6/12 of the 800. The reason is that the Shika was a subsidiary in the first 6 months, but an associate in the second 6 months. While Shuja was acquired during the year and it was only a group member for 6 months. Then we have admin expenses. Admin expenses, we have 1,800. 6/12 of the 800. 6/12 of the 1,200. We don't have impairment loss for the year, so we are able to calculate this. Then we get the profit from operations. So I can get that 1,200 plus the 300 plus the 400. That's 1,900. 1,800 plus the 400 plus the 600. That's the 2,800. That is 8,200 plus 600 minus 480 minus 1,900 minus 2,800. So we are getting that 620. Then we less finance costs. Finance cost here, friends, is 200 plus 6/12 of 100 plus 6/12 of 100. That is 300. Then we add group share of PAT in associate. Now there is an associate which is Shika, and that is 40%. Profit after tax is the 700, 6/12. That definitely comes to 140. Then we less tax expense. The group tax expense will take 600. A half of 300 is 150. 6/12 of the 500 is 250. So we are going to subtract that. Then we get the profit for the year. Then we less profit attributable to NCI shareholders. How do we go about it? We know there are two of them. There is the 20% on the profit after tax, which is 700 for 6/12, plus There is the 25% of the 1400, 6/12 as well. So we come and now have this calculator first. I say there is 600 plus 150 plus 250. I get 1,000. There is 20% of 700 by 6/12. 70 plus 25% by 1400. Then divided by, then we are getting 245. So 245 must be subtracted. So we have profit attributable to the parent. So we have that 620 plus 300, minus 300, plus 140, minus 1,000, minus 2 before that, we get 2460, minus 245, we get 2215. So friends, that comes to the end of a group statement of profit or loss account. But now we want to also do the group statement of financial position. We want now to prepare the group statement of financial position. The group statement of financial position. The group statement of financial position. So Unga Limited. So we start with the non-current assets as usual. Non-current assets, we have property, plant, equipment. This one didn't have an adjustment, 6,800, plus the one for Shujaa, 3,000. We didn't have a revaluation surplus. Depreciation undercharge, that one is not there. So we only adjust the two, and that is 9,800. We now have goodwill. Goodwill was negative, so we don't have it actually. But there is investment in an associate. That was 1440. Then we had current assets. We have inventory. Inventory, the one for Hunga is 1,500. The one for Shujaa is 1,200. Then we subtract unrealized profits of 50. We have accounts receivable. We have the receivables. The receivables, there is 4,000. For Hunga, for Shujaa, 3,400. There is intercompany owings between Shujaa and Hunga, that's 300, so we subtract 300. Cash at bank. Cash at bank, we have 1,000 for Hunga and 600 for Shujaa. Then we'll get the total assets up to that point first. I take my calculator. I take the inventory of Hunga plus the inventory of Shuja minus unrealized profits of 50. I get 2650. I take the receivables of Unga 4,000 plus the receivables of Shuja minus the intercompany owings of 300, 7,100. And the other is 1,600. So I had those subtotals, 1440, so 11,240. Then we have 2650 plus 7,100 plus 1,600, we have 11,350 plus 11,240. So we have 22,590. Now we look at equity. Equity, we have ordinary share capital, we have group retained earnings, we have group retained earnings, we have non-controlling interest, so ordinary share capital has no change, the one for the holding company, 6,000 million. Then group retained earnings, we had already worked it out there, 65. Then non-controlling interest, we had already worked it out, 875. Then we come to non-current. There is non-current liabilities. Non-current liabilities, we had only 10% loan stock. The 10% loan stock was never acquired. We have not been told any story about that. It was never acquired, fine. So 10% loan stock is 2,000 plus 1,000 for Shuja, that's 3,000. Current liabilities, we have trade and other payables. Trade and other payables, 2,500 plus 300 minus 300 intercompany owings. There is a current tax. That's 300 plus 400, which is 700. Then we will get the total equity and liabilities. So I take my calculator and say 6,000 plus then we have 2,500 plus 300 minus 300. Plus the 700. So we have 22,590. So that comes to the end of that question. Friends, you have noticed that it's becoming sweeter and sweeter. It's becoming easier and easier. it's becoming more interesting. Remember, with this illustration, we were looking at a scenario whereby we have disposed of shares in a subsidiary, and that subsidiary has become an associate. We have lost control, and this is exactly what we have done. We have consolidated. We have worked out the gain or loss on disposal. We have computed the goodwill. We have noticed that is a negative goodwill. And we have also determined the group retained earnings. We didn't prepare a group statement of changes liquid this time round. We did it here. So you have noticed that we are able to prepare complete information as far as disposal is concerned. This is a case where the former subsidiary became an associate. Shika, to be exact, Shika Limited became an associate after disposal. So thank you very much. You're most welcome in the next session. Now remember, friends, we are developing this further and further. In the next session, we'll want to move and maybe look at another example of a discontinued operation. This is where we have disposed of and become an associate. But we want to look at where we dispose completely. It becomes, we discontinue the operation. How do we go about it? It's very interesting. We may want to do a recap on the same before we do the real question. That is one of the most interesting parts you not afford to miss. Thank you very much. Your host, none other than Spotter Fred. Welcome in the next session. Thank you.
Enroll your child with the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a course-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
I recommend this book which we have developed here at Manifested Publishers. This book, we have solved as many questions as possible in this particular revision partner. Hello learners, welcome again to Manifested e-learning platform. Today I would like us to finalize the tax planning topic with the areas that remained. So we covered some areas like evaluation of job offers, and today I'd like us to look at the remaining subtopics. So the major topics still we are at tax planning, and there are some subtopics that remained which I would like us now to finalize. The subtopic number 1 is tax avoidance. And avoidance provisions or measures. The other subtopic that remained is uses of tax incentives. The other one was disposal of a business operation and restructuring activities. restructuring activities. We also had says a special economic zones, Special Economic Zones Act. And the last one we had tax risks. So let's start with the first part, that is tax avoidance and avoidance measures. Tax avoidance and anti-avoidance measures. And when we talk about tax avoidance, what do we really mean? Tax avoidance is a legal way of reducing the tax burden. It's a professional way of minimizing the tax burden. That is, reducing the tax burden without violating tax rules and regulations. And therefore, if the taxpayer engages in tax avoidance, he cannot be penalized by KRA because that one is a legal practice. Tax avoidance techniques includes, for instance, taking advantage of capital allowances. When you are calculating, for instance, the taxable profit, you can calculate capital allowances, you treat it as an allowable deduction, therefore you end up reducing the taxable profit and tax liability. Again, still, for instance, somebody may want to finance his business, maybe as a manager. So you can finance your business either through equity or through debt capital. So a manager can opt to finance his business through debt capital because he will be required to pay interest, and that interest is allowable when calculating the taxable profit, therefore paying again less tax. Another example is manufacturers. Manufacturers, as a manufacturer, one can manufacture goods for export or for local consumption. If one manufactures goods for export, then exports are zero rated. So VAT is charged at 0%. These are for exporters. But if you are producing goods for local consumption, then you are charged VAT at a standard rate of 16%. So again, somebody can do avoidance by manufacturing goods for export so that one may not be paying VAT. But for local, you will be required to pay VAT at a standard rate of 16%. Then again, we have anti-avoidance measures. Anti-avoidance measures means a situation whereby somebody can engage in tax avoidance technique, but the commissioner say to such transactions. This is covered under Section 23 of the Income Tax Act, and it states that not all transactions are acceptable as tax avoidance techniques. There are two major cases that we can discuss here, which the commissioner can reject such particular transactions. For instance, if we have a director in a given company who buys a car from that particular company at a throwaway price, and that car was bought, it was captured in a given class, maybe for the purpose of calculating the capital allowances. It was included there. Then the director opted to buy it at a throwaway price. So if it is bought at a throwaway price, we subtract that value when calculating the capital allowances. And as you remember, the way we calculate capital allowances, we have classes like class 1, class 2, class 3, all the way up to class 4. So if it is like motor vehicle, it was bought and it captured maybe a lorry in class 1. Maybe it was bought for a price of 20 million. Then after 1 year, the director buy that particular asset at a price of 1 million. And therefore, I'd like you to see, for the purpose of calculating the capital allowance, we less the selling price. And therefore, what will be subtracted is 1 million. We included 20 million, we less now
1 million. And therefore, because this car now is disposed, we will leave figures in the computation of capital allowances like 19 million. We continue to claim for capital allowances, but this asset is not existing. And therefore, that now make the commissioner to reject such a given transaction. Another example is like if maybe we can have a child who is employed like in a company, and this particular child, maybe the company is owned by the parents, but the child is getting very, very high salary. And as you know, it is not possible for the commissioner to enter into a contract with a minor of paying tax. And therefore, if we have a scenario whereby this child is getting very high income, but she's not paying tax, the commissioner will reject such a transaction. And therefore, such a salary, the commissioner will not allow such an expense which is salary to be treated as an allowable expense. The commissioner will either say that salary be treated as disallowable or that income be taxed on the parents. So that is how, those are some of the cases whereby the commissioner can reject some of the tax avoidance practices. And again, for in case of the director buying a car, so the commissioner, the direction that the commissioner take is, the commissioner will come up with a view that what is subtracted here as the disposal value when calculating the capital price, the capital allowances, what is supposed to be deducted is the market value of that particular lorry, but not the selling price like we normally do when we are calculating the capital allowances. So maybe after 1 year, like this particular lorry that we captured in class 1 is likely to have a value of like 18 million. And therefore, when we less that, we will not be claiming capital allowances and the asset is not existing. So that is what maybe we need to understand under tax avoidance and tax avoidance measures. Number 2, we have tax incentives. Tax incentives. We have uses of tax incentives, but first of all, it's good we know what are tax incentives. A tax incentive is an incentive that is granted by the government or KRA to persons or to taxpayers in order to encourage them to continue to pay tax or to attract new taxpayers to the tax system. Remember, we cannot survive with the current revenue that we are generating. The government needs to keep on generating more revenue. And as you know, the government expenditures tend to increase day and again. And therefore, we need to come up with a way of increasing this particular revenue. And one technique is by introducing tax incentives. When we give these incentives, we tend to attract people and or to motivate those people who are paying, and therefore the government is able to raise more and more revenue. Examples of tax incentives, they are like, for instance, taking advantage of capital allowances, like investment deduction for normal manufacturing, or maybe like wear and tear, maybe allowances. We also have personal reliefs, double taxation relief, claiming for input VAT. Those are some of the tax incentives techniques. But now, what are some of the uses? Why do you think the government grant tax incentives to its people? The government grant tax incentives to its people, number 1, maybe like to attract uses. We can give them to attract investors. Remember, we have both local and international investors. And therefore, when we give tax incentives like capital allowances, for instance, investment deduction, we tend to attract investors, and therefore, when they invest, the government tend to raise more and more revenue. We also give tax incentives to motivate existing taxpayers, in order to motivate the existing taxpayers. Those people who are paying tax, remember paying tax is painful, it pinches, and therefore we need to motivate the taxpayers. And therefore, through tax incentives like capital allowances, e.g., wear and tear allowance, where somebody is using his assets to generate taxable income. If you appreciate loss of value of that particular asset, then to some extent, that particular taxpayer feels demotivated and he continue to pay tax. We also give tax incentives in order to discourage tax evasion, Remember, some people feels that the government is taxing them in order for the government just to benefit. So we tax incentives are also given to discourage people from engaging in tax evasion, because the moment you are given this incentive, then you tend to focus more on the government. You tend to see that this is your government, and you develop a positive attitude on the same. Therefore, you are motivated, and it can make you to continue also to pay tax. Also, tax incentives helps to improve tax compliance. So remember, when you give me an incentive, then I feel motivated, and therefore the tax compliance level again tend to increase, which is very, very important in countries, because the moment people are complying, then it means that the government tend to raise the adequate amount of tax. The other one is we also give tax incentive in order to increase future incomes. So you'll find that in future we expect that the government expenditures will increase. So we need to introduce tax incentives today so that we can motivate people, we can attract people, and therefore in future we are likely to find that the revenue is likely to be a bit high. And the last thing is we also give tax incentives in order to make taxpayers develop positive attitudes. So we don't want taxpayers to develop a negative attitude towards the government, and therefore we need to ensure that they have a positive attitude by granting them with the tax incentives. At least they see that this government is caring for us, and therefore tax incentives can help in changing the negative psychology that people tend to have. At least we make sure that our taxpayers have a positive attitude towards our government. Then we also need to look at disposal of a business operation. Disposal of business operation. And the restructuring activities and restructuring activities. And there are some instances whereby a business can be disposed as a going concern. For instance, we can have maybe a trader who has registered with the VAT, and another person also who is registered who is willing to buy that particular business, and KRI can accept a sale of that particular business without charging VAT. Remember, when goods exchange hands or when sales takes place, we are supposed to charge VAT. But there are some cases whereby KRA accepts disposal of business operation without charging VAT, especially where the two persons have registered and the business is being exchanged as a going concern. But for this to be accepted by KRA, there are some things that need to be met within 30 days. The seller need to disclose some information to KRA within 30 days. For instance, the details of those particular transactions should be disclosed to KRA, that is within 30 days. So in that particular case, KRA can accept such without charging VAT. You also need to inform the commissioner how the overdue taxes are supposed to be paid, because the moment the business is operating, it may not have paid maybe all the taxes on time, and therefore to some extent the tax that has not been paid, the commissioner may want to know how that tax is supposed to be paid. So that also has to be made very, very clear, so that that transaction can also be around. The commissioner also will be interested to know the value of taxable goods of that particular business which is being exchanged, so like the value of stock and all that. So the details also need to be provided. And the last one, the details on how or on the person who will be maintaining the records, especially during that particular period. There are some cases where in that case the records have to be maintained. Like we know when we are doing business, records like invoices, cash book and all that. So we don't want to have a gap in the process in this particular transaction. So it has to be made very, very clear to the commissioner who will be maintaining the records, so that we can ensure that no information will miss in the process of doing that particular transaction. And if all that is made, then the commissioner will accept sale of that particular business as a going concern without charging VAT. Then we also have special economic zones. Special economic zones Act. And the Special Economic Zones Act is an act that was implemented by our government in order to encourage or to attract investors. In this particular case, special economic zones are zones that are created or that are set aside by the government, so that we can ensure that we empower the investors in that particular area. So they act more of tax incentives, because there are some benefits that are enjoyed by investors of special economic zones. So this particular act was established so that it can support these particular areas, and what they are doing, it can also remain legal. There are some benefits that are enjoyed by these particular economic zones, like there is element of tax exemption. You'll find that maybe in these particular areas there is no payment of tax, or if there is payment of tax, tax is paid at a lower rate. So either tax exemption or reduced tax rates. So taxes are paid at a lower rate. So in that particular case, therefore, we tend to empower those people who have invested in such zones. The other thing is there is also another benefit that they enjoy, like we have work permits, whereby you find that those investors who are working, who have invested there, they are provided with work permits such that they can carry their business with a lot of freedom. And again also, there is also there is a benefit that is enjoyed, which is a protection of property. Protection of property. Those like intellectual properties, real properties, and such. Those people who have invested there, again, they enjoy such. And maybe also we have capital allowances, special capital allowances. Special capital allowances. This is meant to ensure that we motivate those people who are operating in that particular area. We can also maybe highlight some of the examples, of the types of SPE. That is types of special economic zones. Types of special economic zones. So, like for instance, the country like Kenya, we have a number of special economic zones, including, for instance, agricultural zones, and these agricultural zones, they are meant to ensure that the agricultural sector is improved, and again we can attract many people in farming, so that at least we can boost the production of food in our country. Again, we have number 2, free zone port. These are located at the port, and they affect the matters of import and export. We have also free trade port. Again, it is also established to boost the matters of trade on the same. We also have ICT park, Information Communication Technology Park, and this one is meant to improve the ICT sector to ensure that we attract many investors in IT programs. We also have tourist or recreation zones or park, and again this one is meant to ensure that we boost our tourist industry or recreation industry, and to some extent the government also will be guaranteed of more future revenue. So those are some of the types of special economic zones. So we can finalize with the tax risks, and when we talk about tax risk, this simply means the risk that the taxpayers or the persons may not comply with the tax system. The chance that we have taxpayers, we have persons, they know that they are supposed to pay tax, but there is a chance that they may not comply with that. What are some of the effects of that? If the members of the general public fails to comply with the tax system, then obviously the government will miss the tax revenue. The other thing that will note also, public services may not be offered, like public schools, public hospitals, and again such. We also have development. So it means if people fails to pay tax again, the development obviously has to reduce. So tax risk in most cases can be attributed maybe by the attitude of the persons towards the government or the psychology of the persons. If they have a positive attitude towards the government, then the risk goes down, because obviously chances of complying they are high. But if they have a negative attitude, those people may not comply with the system, and therefore the tax risk increases. So that marks the end of our session. But as I conclude, we agreed that for every class we need to be having some revision questions. So I will seize one or two questions that we can use for the purpose of revision. Like for instance, I have this question from our revision partner, that is May 2017 question 4A. The question reads like this: describe 3 tax planning opportunities that could be derived from financial management decisions in a company. Describe 3 tax planning opportunities that could be derived from financial management decision in a company. So when the managers are making decisions, so which are some of the tax planning techniques that can be exercised, and we end up maybe reducing the tax without violating tax rules and regulation. Again, I can read another one. May 2015 question 1A. In the context of tax avoidance schemes, describe how firms might employ the following approaches to avoid tax. Approach number 1, bankruptcy or liquidity of a firm. How can you reduce tax or avoid tax in case of bankruptcy or liquidity of a firm? Outsourcing services instead of employing permanent staffs. Number 3, purchasing fixed assets instead of leasing the assets. So we need to see you trying to identify those particular tax avoidance techniques in these particular cases, which may not subject somebody to penalties and fines. We have many questions here, so I would like you to attempt all of them, and after you have finished, maybe you can check some solutions at the back of this particular book. We have come to the end, and thank you very much for choosing to study with us, and I hope to meet you in the next session. Thank you.
Enroll your child for the manifested e-learning platform and see their grades grow tremendously. These videos can be downloaded to a laptop for offline viewing or viewed from a smartphone in a course-friendly format.
Kwa hivyo mimi dau langu la mdokezo na ufafanuzi wa fasihi nimelirudisha kwenye ukingo. Tukutane tena katika somo lingine tutakapolipanda lile dau, tuende katika maswala ya uchambuzi wa kina ya hiki kitabu Tumbo Lisilo Shiba.
Host, none other than Dr. Spotter Fred. Friends, I'm here to take you through advanced financial management.
And in pursuit of expanding frontiers of knowledge, I will be your instructor in financial accounting.
My name is Luke Mbom, and I'll be taking you through the MIS, that is Management Information Systems sessions.
I'm Mike Onganga, the instructor for Advanced Public Finance and Taxation.
Publishers.
Hi everyone, and welcome to today's learning session. The subject is Advanced Portfolio Management. We're still on the first topic, which is managing individual portfolios and institutional investors. In our last session, we began on a section known as investor characteristics. We saw that before an investment manager develops an investment policy, before an investment policy statement is developed by a manager, the investment advisor or manager has to understand the investor. And for the investment advisor to understand an investor, then that investment manager has to study the investor's characteristics. We saw that investor characteristics are grouped into 2. One situational profiling and psychological profiling. We defined profiling and say that it refers to the recording and analysis of a person's psychological and behavioral characteristics so as to assess or predict their capabilities in a certain sphere. And profiling is done so as to identify categories of people. So in finance, when we do profiling, we focus on situational profiling and also the psychological profiling. So learners, that's what we learned in our last lesson, and we went further to discuss the situational profiling. Situational profiling. We saw that situational profiling refers to the considering an investor's basic philosophy and preferences while facilitating the discussion of investment risk. And that is done by anticipating areas of potential concern or areas of special importance to the investor. In situational profiling, we study the circumstances. Situational profiling, we learned that seeks to anticipate an individual's concerns and also risk tolerance by specifying the investor's, 1, source of wealth, 2, the perceived measure of wealth, and 3, stages of life. So we discussed in detail source of wealth and perceived measure of wealth of an investor. In our today's lesson, I want us to discuss the third point, which is the stage of life. So the subtopic is investor characteristics. Investor characteristics. Investor characteristics. Investor characteristics. Remember, learners still under situational profiling. We still under investor profiling, but now we want to focus on stage of life. Stages of life. Stages of life. And I've said situational profiling helps the managers to understand an investor's motivation based on their source of wealth, based on their measure of wealth, and also stage of life. Stage of life. So learners, stage of life. As an investment advisor, you may want to consider the stage of life of an individual in order to understand that investor. And in life stage classifications, the investment policy and particularly the risk tolerance are determined by one's progress on the journey from childhood to youth, to adulthood, to maturity, to retirement and death. Okay, these are the stages. I've mentioned childhood, youth, maturity. Childhood, youth, maturity. Another stage is retirement and death. These are the stages of life. We call them life stage classifications. So theoretically, learners, a person's ability to accept risk should begin at a higher level and gradually decline through his lifetime. That is theoretically speaking. Theoretically, a person's ability to accept risk, a person's ability to accept risk, a person's ability to accept risk should begin at a higher level. Should begin at a higher level and then gradually decline, okay? And gradually decline through his lifetime. And gradually decline through his lifetime. Lifetime from childhood to death. That is a very important point, learners. But while this is happening, while the willingness, we know that the willingness to assume risk, the willingness to assume risk should be driven by cash flow considerations, largely by cash flow consideration. The willingness to assume risk is driven largely by cash flow considerations. Cash flow considerations, we are referring to the incomes and expenses of an individual. So the human financial condition, learners, is driven by additional factors. There are additional factors such as life experiences, the living conditions of an investor, the starting point on the scale of wealth. There are other factors like personal abilities, personal ambitions, and so on. That's why I said theoretically. A person's ability to accept risks should begin at a higher level and gradually decline through his lifetime. While willingness to assume risk should be driven largely by cash flow considerations. These are individuals' expenses, individuals' incomes, and so on. But we all know that the human financial condition, my financial condition, is driven by other factors. There are additional factors like life experiences. We go through different life experiences that either positively or negatively impact on our financial conditions. The living conditions, the starting point of an individual's scale of wealth. There are those who start from zero. Okay, you complete your school, you have no inheritance, you have no advantages, you have nothing. It's just your clothes and your shoes. You have, that's the only asset that one individual may have. Another one may have stable wealth. Another one may have a starting point of that is stable. Maybe an individual has inherited private property or land or buildings, commercial houses. So those are factors, learners. The human condition is driven by other factors other than just what we are referring to here, the stages of life. Okay? The human financial condition is driven by additional factors. So, but generally, learners, an individual's investment policy can be viewed as passing through some general phases. And these phases are: 1, foundation phase; 2, the accumulation phase; 3, the maintenance phase; 4, the distribution phase. So an individual's investment policy, that's a very important point to note down, that an individual's investment policy, an individual's investment policy can be viewed as passing I said can be viewed as passing through general phases, which are foundation, accumulation, foundation phase, accumulation phase. There is the maintenance phase. Foundation phase, accumulation phase, maintenance phase, and then lastly, and distribution. So an individual's investment policy can be viewed as passing through general phases such as the foundation phase, accumulation phase, maintenance phase, and the distribution phase. Now, learners, during the foundation phase, and that is the foundation phase of life. Okay, during the foundation phase of life, the individual is establishing the base from which wealth will be increased or will be created. During this foundation phase, the individual establishes the base from which wealth will be created. And this base may be, say, improving marketable skills, okay? Establishing a business, acquiring educational degrees, acquiring certifications. That is the foundation phase. Studying, taking a professional course, doing a master's degree, establishing a business, incorporating sole proprietorship, establishing, learners, that is laying the foundation upon which wealth can be created. And during this foundation phase, the individual is usually young. The individual at that point in life is young, okay? And if the individual is young, then that means that that individual has a long time horizon, investment horizon. He has a long time horizon. And at that point, that long time horizon can be associated with above average tolerance of risk, a high average tolerance for risk. If you know you have many years ahead of you, then you can easily take risks now because you have time to recover in case you fail in whatever investment you are making. So during the foundation phase learners, the individual, number one, is usually young. And if the individual is young, then that means that that individual has a long time horizon, which normally would be associated with an above average tolerance for risk. That is foundation phase. And learners, the risk tolerance we are talking about in relation to this young investor should be above average if that individual has inherited wealth. If that individual has what? Has inherited wealth. Remember, we had mentioned that we do not all start at the same scale of wealth. There are those who may have inherited wealth when they are young. There are those who may not. Okay? Now, lacking such wealth, the foundation phase may be the period when an individual's investable assets are at their lowest and financial uncertainty is at its highest. So do you get the point? An individual, let me repeat, an individual whose risk tolerance is above average at the foundation stage is the individual who has inherited wealth. But the one who lacks this inherited wealth at the foundation phase may not have investable assets. The investable assets are at the lowest. And at the same time, the financial uncertainty is at its highest. So learners, a young entrepreneur may have substantial expenses in establishing a business, which results in liquidity need that overrides all other considerations. At that foundation phase, learners, we may have individuals who may be planning to marry. At the same time, we may have the arrival of children. So marriage and arrival of children may also create a desire for more rapid wealth accumulation that may not be well matched by either ability or willingness to assume risk. We are now talking about accumulation. You see how the concepts are related, the phases are related. So in the accumulation phase, earnings accelerate as returns accrue from the marketable skills and abilities acquired during the foundation period, and also and gradually reach their peak. So in the early years of accumulation, phase, income rises and investable assets begin to accumulate. But at the same time, the expenses will rise during this period. And they are rising through other expenses like the establishment of a family, purchases of homes, and care of children, educating children, and so on. So that in the later years of the accumulation period, in the later years of accumulation of wealth, we're talking about later years, expenses begin to do what? To decline. And expenses decline because maybe children are through with school, they are through with adulthood, education needs are fulfilled, your children have gone to school, they've completed the university. That is at the later age period of wealth accumulation. So the expenses go down. But when you are at the early years of wealth accumulation, the expenses increase because of establishment of homes, paying of school fees, dowry, establishment of a marriage, and so on. But as time goes by, through the accumulation phase, these expenses go down. Why? Because the children reach adulthood. The children should be moving away from the home. All the education needs have been met. The education needs have been fulfilled. And if you were paying maybe loans for housing, or you had taken loan to build houses, you've already completed the home purchases, and so on. So at the later stages of wealth accumulation, income generally continues to rise as the individual reaches peak productivity. At that point, you may have gained experience at the workplace if you are employed, and you've also been promoted because of experience. Okay? So if an individual's personal spending habits do not change, because we've seen individuals, when their income increases, they also increase their expenditure. They move houses, they change lifestyle, they buy new cars, they buy choppers and all that. So as the income, such individuals, as income increases, they also increase their living standard. The living standard goes up. But if I'm saying, if an individual's personal spending habits do not change, then the gap between income and expenses may widen throughout the accumulation phase, allowing for an increase in savings. But there are some individuals who may forego investing. As wealth increases, there are those who don't invest. They don't invest their growing wealth, but instead they increase spending on luxury items. There are those who may not spend money on luxury items, but they may engage in giving gifts to relatives, to charities. If the individual has one wife, may marry other 2, 3 wives. So for investors, learners, however, the accumulation phase, for those who invest, their accumulation phase is characterized by increased risk tolerance, which is driven by increased wealth. and still long-term investment horizon. Okay? Accumulation phase. Now, talking of the maintenance phase. Now, we've moved from accumulation, we are now on maintenance phase. Now, learners, during the maintenance phase, the individual has moved into later years of life. You are no longer a youth. You are no longer a child. The things you used to do when you were a child, you no longer do. Okay? You completed your education. You got employed, or you started a business. You married. You paid dowry. You built houses. You've educated your children. Your children are out of the home. You've been, say, there are two categories of people here during accumulation. There are those, we say that expenses goes down, then they have investable assets. There are those who invest. There are those who waste. It's either you invest or waste. There are those who waste. So learners at the maintenance phase, during this period, the individual has moved into later years of life. And usually you find the individual has retired from daily activities, from daily employment, or from pressure of owning a business. That individual has no pressure to own a business. He is retired from daily employment. Now, this phase, learners, the maintenance phase, learners, this phase focuses on maintaining the desired lifestyle. The maintenance phase focuses on maintaining the desired lifestyle and financial security. Two things. The individual has been accumulating wealth, okay? He's now appearing in his later years where there is no pressure to start a business. There is no desire of employment, but he has developed a certain lifestyle whose objective at the maintenance phase is to maintain, is to sustain, okay? So I've said the maintenance phase focuses on maintaining the desired lifestyle, and that is one. Then number two, financial security. And that simply means preservation, preserving the accumulated wealth, preserving the accumulated wealth, preserving. So preserving accumulated wealth begins to do what? To increase in importance. While the growth of wealth may begin to decline in importance. So ultimately, or consequently, risk tolerance will also decline, because again the individual's time horizon will begin to shorten. So, but this individual may have confidence in his ability to replace capital or recover from any losses. That is if he intends to invest, okay? So in the maintenance phase, investors will typically reduce exposure to higher volatility assets. like the common stocks. All right? But they will increase exposure to lower volatility investments, such as intermediate term bonds, because learners, the individual now has less time to recover from poor investment results. Is very little time, because we are talking of an individual who is in his later years of life. So he will focus on portfolio stability. Portfolio stability. Portfolio stability will become more important, will be increasingly important to the individual at the maintenance phase. So learners in this phase, in the maintenance phase, the challenge is to achieve a desired level of portfolio stability and maintain an exposure to risky assets sufficient to preserve the portfolio's purchasing power. And those investors at this phase will become too conservative. Those who become too conservative too soon after retirement may reach an elderly age with assets that have suffered significant decline in purchasing power. Those who maintain on that, because at this stage we've said investors will focus on in portfolio stability. Those who are too conservative, because they don't want to risk, they may end up as they age, they may end up with a portfolio that have deteriorated or declined purchasing power. So that is the danger of becoming too conservative or at this stage. Now, how about the distribution phase? Now, in the distribution phase, the accumulated wealth is transferred to other persons. The accumulated wealth is distributed to other persons during the distribution phase. Just as the name suggests, distribution is derived from the word distribute. In distribution phase, the wealth that has been accumulated and maintained is distributed to other persons or transferred to other persons or entities. And for many, this phase, learners, for many, the distribution phase begins when the individual is still reaping the benefits of the maintenance phase. Okay? For many, it may begin while the individual is still enjoying the benefits of the maintenance phase. The maintenance phase and even during retirement. And for most people, the phase involves a conscious decision to begin to transfer wealth, especially in the Western culture. In the African culture, it's a bit tricky. In the Western culture, that happens frequently. But in the African culture, individuals rarely distribute wealth while they are still alive. They don't make any conscious effort or decision to transfer their wealth. Because I think due to cultural factors, sometimes it's not good to anticipate your death. Okay? That's a discussion for another day. But learners, at this phase, the distribution phase, dealing with tax constraints often becomes an important consideration. A very important consideration. A very important consideration in investment planning, learners, as investors seek to maximize the after-tax value of assets that are transferred to others. And although asset distribution begins much earlier, learners, although asset distribution, I may say, may take place in the later stages of life, planning for such transfers can be or should begin much earlier. And especially for the individuals who have substantial wealth, individuals with substantial wealth, learners, the distribution phase should be a well-planned program executed during the course of several years. And efficient wealth transfers, learners, efficient wealth transfers take advantage of market conditions. They take advantage of tax laws and various transfer mechanisms. So an individual may consider various transfer strategies. He might establish trusts. An individual may establish foundations for their heirs or for charities, okay? So he might establish trusts. We've seen individuals who establish trusts, those who establish charities, and so on. There are those who may even make outright gifts of assets, outright gifts of cash. There are those who will modify the legal ownership structure of certain assets. There are those who make advance provision for care in the event of health problems and to pay for wealth transfer taxes. So that is the distribution phase. We've said that if an individual has substantial wealth, then the transfer of wealth should start much earlier. Okay? Should take place much earlier. So learners, these are the phases. We've said an individual's investment policy can be viewed as passing through general phases such as foundation phase, accumulation, maintenance, and distribution. It's important to, however, note that although the progression from accumulation to distribution may be linear, that is not necessarily so in real life. I've been explaining as though things are just linear. They take place one after the other. No, that may not be necessarily so. Individuals, learners in accumulation, for example, individuals in accumulation phase may become dissatisfied with their career choice and return to the foundation phase. There are those who may come at this point and they become dissatisfied with their career choices. There are those who may think that they need to do business, establish a business at this level when they are still young, okay? I'm talking about accumulation. At accumulation, when we learn that accumulation takes place when an individual is relatively young. And I've explained as though that happens all the time. No, that is not a linear progression. There are those who at accumulation phase may be dissatisfied with whatever choice they made. And we have many, okay, who change careers in their 40s, in their 50s, because they are dissatisfied with their career choice. And they return, not at accumulation, they return to the foundation phase. Take another course, 5 years. An individual at accumulation who thought that his desire is to practice law, studied 10 years, practiced 2 years, 12 years. After that, he discovered that his passion is in carpentry. So he goes back to a technical college and begins training as a carpenter. Foundation. And some may be forced to take such a move as demand for their skill diminishes. You are this phase, foundation phase, and the skills that you studied for in the market have diminished. Maybe accounting skills or whatever skills that you've taken, they are no longer in demand. So some may shift from accumulation phase to foundation phase because of the low demand of their skills. The demand for their skill diminishes. There are those who may fall suddenly ill, or there are some individuals who may be engaged in accidents. A sudden illness or an accident may move an individual unexpectedly to the distribution phase. An individual may have accumulated a lot of wealth, substantial wealth. So instead of going to maintenance phase, an individual may shift to distribution phase because of sudden illness, where the individual perceives that he may not live long, then the individual may move to distribute wealth. So the point I'm making here is, although the progression of accumulation, okay, to distribution may seem linear, it is not necessarily so. And I've explained why that may be the case. So learners, that will mark the end of our today's lesson, where we sought to study the stages of life of an investor under the situation of profiling. We've seen why it's important for an investment advisor to study the circumstances of an investor before developing an investment policy statement. It's important to study the stages of life so that you can come up with an appropriate investment policy statement for an individual investor. Remember, the broader topic is managing individual portfolios and institutional investors. We still under the individual investors, and we've this will mark the end of the first part of investor characteristics, which is situational profiling. In our next lesson, we begin with psychological profiling. Psychological profiling, and we shall see later on that as we move into psychological profiling that is a whole different process. Okay, under situational profiling, we've been looking at the circumstances, okay, of the investor. We've been studying the characteristics based on circumstances. The individual source of wealth, the measure of wealth, and stages of life. But under psychological profiling, we'll be looking at other psychological processes by which an individual establishes his or her investment preferences. And we shall learn that it's a whole different process that profiles or addresses human behavioral patterns and personality characteristics, as opposed to the situations or the circumstances. So on that note, learners, I'm going to give you a revision question. This is your revision, today's revision question. It says, an individual's investment policy can be viewed as passing through general phases, which are foundation, accumulation, maintenance, and distribution. Discuss. So learners, make sure you do the question before coming to our next lesson, where we'll consider the second part of investor characteristics, which is psychological profiling. Thank you for being attentive, and may God bless you. Bye-bye.
Professionals are constantly in a frantic race for the best paying jobs. Equipping yourself with the best book provides you with a pool of knowledge that can launch you into the position of your dream. For the last 12 years, Manifested Publishers has been providing well-researched study materials that are packed with rich content, accurate and updated constantly to conform to the latest syllabus. These study text and revision partners, by a team of experts led by Sagwa Philip Ndeda, cover Kasneb courses like Certified Public Accountants, Certified Secretaries, Accounting Technicians Diploma, Certified Accounting and Management Skills, and Certified Investment and Financial Analyst. Order your copy online today at www.manifestedpublishers.com or call 0724 173 845 and we will freely deliver to your town in 24 hours. For Nairobi residents, visit our bookshop at Pioneer House, 3rd floor, opposite Fire Station, Tomboya Street. We open from 8 a.m. to 8 p.m.
Welcome learners to our today's session. In today's session, we are going to look into two issues. One is a put-call parity condition in the pricing of options, and the second one is the pricing of option using a one-period binomial tree. This is after, in the last session, we looked into the 6 factors that affect the value of an option, from things like the risk-free rate, the price of the underlying, the volatility, and whether the underlying asset gives what? Either benefit or cost, among others. So today's lesson, we are going to look at the put-call parity, still under pricing and valuation of derivatives. Today's session, we are going to look at the put-call parity And in the put call parity, we are going to look at two things: a fiduciary call and a protective put. From there on, we are going to look into the introductory bit of pricing and valuation of options using the one period binomial tree. So, to begin with, how do we understand the put-call parity condition? The two put-call parity condition is a derivation based on two things: the combination of the fiduciary call and protective put. So we have the fiduciary call and the protective put. So, what is a fiduciary call? A fiduciary call is a combination of a call option with the exercise price X from our previous lessons and a put and a pure discount riskless bond that pays X at maturity. So we are saying we have a call and pure discount riskless bond. Pure discount riskless or riskless bond. And this bond pays X at maturity. So, bonds can be issued at discount or even at par. So, we are talking about a bond that is issued what? At discount. What do we mean a bond issued at discount? A bond can be issued at discount, meaning that it is issued less than par. For example, if you have a 100 par value bond and then you issue it at 97 shillings, then it means that the issue price is what? Less than the 100. It means the 3 shillings, 100 minus 97, will be paid on what? On maturity. So, X is what? Our bond price that will be paid at maturity. And the exercise price of the call exercise is also what? X. In that combination, you have a fiduciary call. What of a protective put? A protective put is a share of stock together with the put option on the stock. So we have a share and the put option on that share. Having understood that, we can ask ourselves, what is the payoffs under this condition? There are two types of payoff in the fiduciary call. The payoff. We remember from our previous sessions, a payoff can either be an out of the money or in the money. If the call option is out of the money, means that it will not be exercised. Therefore, under the fiduciary call, our payoff for out of the money, the payoff will be what? What the pure discount will pay. Remember, this is a bond issued by the government. That's why we are calling it what? Riskless or gilt-edged security. But if it is in the money, it means that the payoff then will be X paid by the bond plus the difference between the strike price at the expiration with the exercise price. So what we are going to get from the bond plus the value of the option. Then from the protective put, similarly we say that if, what is the payoff here? Similar way, it can be out of the money. The put option can be out of the money. And if it is out of the money, then we get the price of the underlying, the price of the share. If it is in the money, we get what? We get X minus ST, the value of the put option, plus what? The value of the share. So those two conditions, the fiduciary call and protective put, will give us what we call the put call parity. Remember, in our discussions, we have been saying that pricing and valuation of derivative instrument occurs under the no arbitrage condition, and if the no arbitrage condition to hold, then we state that the portfolio with identical payoffs regardless of the future conditions must sell at the same price to prevent arbitrage. Our no arbitrage condition holds that portfolio with identical payoffs regardless of the future conditions must sell at the same price to prevent arbitrage. What do we mean by that? We mean that, remember, in our core, we say there is the value of the core plus the discounted value of the bond at the risk-free rate, which should be equal to the value of the share with the protective put plus the value of the put. What do we mean here? Where C is the value of the call option, X is the bond's value, it's strike with the same same price as what? The strike price X. S is the value of the underlying. Share. And P is the value of the put. Then this relationship gives us what we call the put call parity. And for you to get either the value of the call, you have what we call the synthetic call. The synthetic How do we determine the synthetic call? Let us see an example. Suppose that the current stock price is shillings 52. The risk-free rate is 5%. You have found a quote for a 3-month put option with an exercise price of shillings 50. The put price is shillings 1.5. But due to light trading of the call options, there was no listed quote for a 3-month shillings 50 call. Estimate the price of a 3-month call option. So what we are given here in our example is that the current price of the stock is S, which we will say is what? 52. We are also saying that the risk-free rate, RF, from our equation here, the RF is the risk-free rate, which is 5%. We are also saying that the put price is 1.5. So our P is 1.5. We are also saying that for a quote of a 3-month call, so is what? Is 50. So our X will be 50. So what is required is to estimate the price of our 3-month call option. From our formula of put call parity, we can derive the value of what? We can derive the value of the call. And the call that will be derived from the put call parity will be what we're calling the synthetic call. And that is how we go about it. So we make C the subject of our formula. C means that this factor X divided by 1 plus RF goes to the other side. And when this factor comes to the other side, it means it will take the negative position. So our C will be S plus P minus X over 1 plus RF T. So in our example here, we are told quote for 3 months. So our T is equals to 3 over 12. Yeah, our time is that. So we can say that we know our S is 52. Our P is 1.5. Our X is 50. Our risk-free rate is 1.05 plus 1. Our time is 3 over 12. So this gives me 52 plus 1.5, 53.5 minus, 50 divided by 1.05 is power 3 divided by 12. 49.39. 53.5 minus answer gives me approximately shillings 4.11. Yeah. So what remark do we need to give? We need to say that this means that if a 3-month call option is available in the market, it should be priced within the ranges of what? Shillings 4.11. And that therefore gives us what we call a synthetic call. From that, you can derive, you can make this factor X to be the subject of the formula. Then there you'll be having what? The synthetic bond. You can also make that S to be the subject of the formula. You have the synthetic stock, and P can be the subject of the formula, which will give you the synthetic put respectively from the put call parity. How then, in our next learning, do we value an option using a 1-period binomial model? I know from your previous study session, using quantitative analysis, you've come to appreciate that a binomial model is based on the idea that some value will change to one of the two possible outcomes. So, as far as options are concerned, options like we have seen, they can be either in the money or out of the money. We also seen that from the factors affecting the exchange rate, the factor can be either high volatility or there will be a possibility of low volatility. Yeah, having seen that, we can say what are the requirements to so pricing and valuation of option using the binomial model. So we have seen that the binomial model includes what? Includes those factors that can vary from either high or low to outcomes. So what requirements do we have? What are the requirements? The first requirement is the beginning asset value. The beginning asset value, yeah, which is the underlying. We also require the size of two changes. This is the up move, up and down moves. Yeah. We also require the probabilities of these changes occurring. What is the probability of these changes occurring? The probability of an up move and down move are calculated on the size of moves and the risk-free rate. So the probability of the up move, the probability of the up move, which we call the risk-neutral probability, is denoted as the risk-neutral probability, like that, of the up move, risk-neutral probability of the up move will be given by 1 plus the risk-free rate minus the D, which is the down move, the size of down move, U minus D, where RF is the risk-free rate, D is the size of down move, U is the size of up move. So this will give you the risk-neutral probability of the up move. So the risk-neutral probability of the down move, is given by 1 minus the risk-neutral probability of the up move. So this is the risk-neutral probability of down move. Risk-neutral probability of down move. We also know that for us to get the down move, D, which is the size of the down move, is given by 1 over U, which is the size of the up move. So, and what do we mean in respective? So that we know, given a starting asset price maybe of SO, it can move either up or it can move either down with the risk-neutral probability of the up move and risk-neutral probability of the down move. such that now the size of the up move here, SO times the size of the up move, and SO by, this will give by S superstar, SO by the size of the down move will give us S minor. Yeah, that is a representation, the general representation of what? A binomial model. One period. Let us conceptualize this with an example. Example, using a binomial tree to calculate the value today of a 1-year call option on the stock with an exercise price of 30, assume a risk-free rate of 7%. The current value of the stock is shillings 30. The size of up move is 1.33. Let us conceptualize this using the example we have read. So we have been given by the following, that the size of up move is 1.333. The risk-free rate has been given by 7%. The current stock price has been given as 30. Our exercise price is also 30. Our exercise price is also 30. So what are we required to do? We are using the binomial tree, calculate the value today. So we can say from this, what is our down move? Our down move D will be given by 1 over U, the size of up move, 1 over 1.333. It's approximately 0.75. So to present this information in a binomial tree, we are going to have S naught, yeah, can go up or down, yeah, and we know this is what? 30. So to get our S plus, yeah, we know is S naught times what? The up move, which is which is equals to 30 times 1.333 to give me approximately 40 shillings 40. So my S minor will be SO minus down move, which is 30 times 0.75. Shillings 22.5. Now, what is the probability of the up move? What is the probability of the up move? The probability of the up move is given by, the probability of up move is given by 1 plus the risk-free rate minus the D over U minus D. 1 risk-free rate is 0.07 and down move is 0.75 over U is 1.333 minus 0.75. this gives me 0.55. 0.55. So if this is 0.55, what is the risk neutral probability of the down move? Will be 1 minus 0.55, which will be 0.45. Then, since we have determined our ST given the up move is 40, we know this is a call option. So the value of the call option plus will be given by the maximum, the maximum of 0 ST minus X, which is equals to 0 40 minus 30. Exercise price is 30, which will give me 10 over there. Same at S bar, SC minor will be 0 of 22.5 minus X. 30, since this is negative, so the value can be 0. Yeah, so that has given us the value of the call option with the up move and the value of the call option with the down move. So what is the average value of the call today? What is the average value of the call today? The average value of the call today, or the expected value, will be given by the discounted rates at the C plus and the C minor. So it will be 10 times the probability of that occurring, 0.55 plus 0 times the probability of that occurring, 0.45, divided by the risk-free, 1 plus the risk-free rate, 1 plus 0.07. So the value of the call with the up move, which is 10, and the probability of the up move, which is 0.55, that is, and the call with the down move, which is 0, with the probability of the down move 0.45, and we discount it by the risk-free rate today. This gives me 10 times 0.45 divided by 1.07. This gives me approximately shillings 5.14. So therefore we have seen that given the value of using the binomial tree, which is a 1 period, and given the information with the up and down move, we can be able to come there to discount that value of the option today. Having said that, and having understood that valuation, this brings us to the end of our today's session. We have been able to study and learn what a fiduciary call is. That is, combining a call option with a riskless bond, which value is the exercise price X. We have also seen what is a protective put, combining a put option with an underlying, which is a share. And when you combine a fiduciary core to a protective put, you come about with a concept which you've called the put-core parity. We have said from the formula, that you can derive a synthetic core, you can derive a synthetic put, and synthetic bond and a synthetic share. We have seen that in brief how to value an option using the binomial tree for one period. We have seen that what you need is the beginning asset value, the size of the two changes, which can be the up move or the down move, and the probabilities. Given the risk-free rate and given the size of either an up or down move, we can come about how we do what? We come with the value of the core with the up move and value of the core with up move. Do not forget, once you get this value, to get the average value, and you discount it what? To today's value, because they occur a year from now. We want the value today. You discount using the risk-free rate. With that, thank you. Our next section, we will dwell on the Black's course model.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station. Anyway, CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestpublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime from anywhere. Download CPA video lectures from www.manifestuspublishers.com. CPA students can now access top-notch lecturers anytime